From Cape to Cairo, Africa stands as one of the most spectacular expressions of nature, of history, and human possibility on earth. From the snow-crowned majesty of Mount Kilimanjaro to the timeless strength of Mount Kenya to the oceans embracing Table Mountain at the southern tip of our continent, welcome. From the vast breathing green of the Congo Basin rainforest, one of the great lungs of the planet, to the ancient life-giving flow of the River Nile, welcome. This is such a wonderful place to be at this point in time. One may think of the Victoria Falls, the Zambezi River, the Nile River, and just be awestruck at how such a great continent until this time did not have its own credit rating agencies and did not have its own credit rating agency association. This continent is a continent of giants, not just in landscape, in resources, in culture, and in its people. Africa reminds one of the need for humility whenever one faces the possibility of explaining to Africans how great they are. And above even time itself is the concept that Africa is the birthplace of humanity. And we are so proud to be sitting here today together, all of us as Africans that are proud of our humanity. Africa is not poor in assets. Africa is rich in land, in water, in minerals, in heritage, in creativity, and above all, in human potential. The question before us has never been whether Africa is great. The real question is whether we are ready to fully claim, organize, and unleash the greatness. We gather here not just to inaugurate an organization, but to initiate a recalibration of how Africa is assessed, of how Africa is understood, and ultimately how Africa is financed. Credit ratings are not neutral instruments, contrary to some conventional wisdom in certain places. They influence capital flows, they influence interest rates, investment appetite, and national policy tones. They shape how risk is perceived, and often long before risk is properly understood. For decades, Africa's credit story has been told largely from the outside, through lenses developed for other economies, based on assumptions not always grounded in African realities and frameworks that sometimes mistake structural difference for structural weakness. This, ladies and gentlemen, is not to deny risk. It is to insist on the accuracy, context, and fairness of credit rating measures. ACRA is born from a simple but powerful conviction. Africa must have an authoritative voice in defining how Africa creditworthiness is evaluated. Consider the imbalance that we are trying to correct. Africa holds around 35% of the world's natural resources, yet it accounts for less than 3% of the global GDP. Despite this wealth, roughly 40% of Africans live below the international poverty line, and the continent is home to more than half of the world's extreme poor, notwithstanding the staggering statistics confirming its vast resources and wealth that lies not just on top of its surface, but also underneath. At the same time, African governments and businesses routinely face borrowing costs 2 or 3 times higher than peers elsewhere, where comparable fundamentals are in place. A single credit downgrade can cost countries hundreds of millions of dollars each year in additional debt servicing costs. Resources diverted away from development. This is not merely a financing problem. It is a systemic mispricing problem that the world faces. And this is the gap that ACRA exists to try and address. A critical question we must confront openly is whether it is ethical to prioritize profits over people in the construction of ratings, rankings, and measurement systems. Across Africa, ratings have too often been designed and interpreted in ways that appear neutral on the surface, and yet in practice serve the interests of external organizations that are known to be extractive in their relationship with the African continent. And whether or not the world sees itself as a place where ethics matter, where humanity matters, where communities that they serve matter, is a question that is under consideration. Surely, Africa will not trade its soul at the altar of the principle that says that the might of money is morally infallible. ACRA is not about lowering standards, it is about promoting them. We are not here to promote Africa. We are here to make sure that it is correctly measured. It is not about shielding governments or institutions from scrutiny. On the contrary, ACRA stands for rigorous methodology, transparent assumptions, data integrity, professional independence, and global comparability. And hence, it's important when we use the word independence in defining ourselves. It also stands for contextual intelligence, developmental awareness, and a deep understanding of African economic structures. If you look around the room, you will see that you are surrounded by consummate professionals that are competent and qualified in their trades, and they are not here just merely to express a desire for Africa to be great, but for Africa to be measured in a great way. The theme of today's dialogue, defining Africa's credit future, is intentional because the future will not define itself. It will be shaped by the data we choose to value, the risks we choose to measure, the assumptions we choose to challenge, and the voices we choose to elevate. ACRA is Pan-African by design. ACRA is not merely about one market on the continent. It's about all the continents, from Bujumbura to Lagos. Africa is not one economy, but neither is it a collection of disconnected risk islands. Today is not the end of a journey. It is the opening of one. We invite regulators, investors, academics, and institutions to engage critically in an unbiased way, to challenge rigorously, and collaborate constructively. ACRA will earn its legitimacy not by proclamation, but by performance. We understand where we are. We understand our GPS coordinates, and we understand the type of flight and speed that is needed to extract us out of the position that says we enjoy over 50% of the world's poor right here on the African continent. Africa is one place where it often makes sense and sounds good to say, son of the soil or daughter of the soil. And as sons and daughters of the soil, we make that proclamation that we will serve Africa through ACRA in our various engagements and in our various institutions. I'd like at this point to thank all the individuals and organizations that have volunteered to join hands with us as we traverse this bold new road. Today is a significant milestone in our journey, and one that history will record and recall in future. I close with a poignant African aphorism. The goat that steals the salt enjoys it until the rain comes. Ladies and gentlemen, I can hear the African thunder. The clouds are gathering. It is about to rain. ACRA is not just about credit ratings only. This is a tipping point for the continent. If credit worthiness is externally determined, it would be wrong and short-sighted to assume that the credit ratings are the only phenomena that is externally determined and calibrated. Awake, Africa. Africa, awake. May this association help Africa and its friends go far, together with confidence, credibility, and clarity. Thank you.
Thank you so much, Doctor. I'd like you guys to help me with a proverb, an African proverb. If you want to go fast, go. If you want to go fast, go. If you want to go far, go. If you want to go far, go. And that is what ACRA is about. It's about going further and going further together. Just if you want to go to the bathroom, you don't have to go together, but you have to go this way. If you need the restroom, just use that exit there. It's on my left. The ladies is on this floor, and the gents is on the floor just below us. If everybody could please just put their phone on silent, and you are allowed to take out your phone if you're going to take a picture or a video to record this historic moment and post it on our social media. Please tag us. We are ACRA on LinkedIn. If you would like to heed the call of joining us as ACRA, we have the information desk right at the back there to get more information, to hear how you can collaborate and help us go further. Next up, we have Dr. Daniel Cash. Dr. Daniel Cash will be joining us virtually. He's a leading academic and global expert on credit rating systems, ESG regulation, and financial governance. His research examines how credit ratings shape access to finance and how governance frameworks can be improved to better serve economies and societies, particularly in developing and emerging markets like Africa. He's a founder of the Credit Rating Research Initiative, CRRI, and a senior fellow at the United Nations University Center for Policy Research. There, he leads policy and research projects on sovereign credit, development finance, and financial regulation. His work has informed UNDP initiatives, financing for development processes, and African sovereign debt strategies. Ladies and gentlemen, join me in welcoming Dr. Daniel Cash.
Thank you, everybody. Hopefully you can hear me. And it's a genuine pleasure to be with you this morning to join this launch of a very important association moving forward. And for my speech today, what I'll talk about is the potential future for Africa from a credit perspective, and as I'll mention, more importantly, from a governance perspective, because increasingly sovereign credit ratings have been understood and are rightly identified as not just being about credit, but they're also about governance and governance infrastructure. So it's more about trust, credibility, and positioning within the global financial system, and how decisions are taken in the coming years will affect Africa's development on that front. So to start with, I'd like to focus on this understanding that credit ratings are essentially governance infrastructure and what that means. So instead of just being opinions on creditworthiness at source, their effect is that they affect governance infrastructure. They shape borrowing for different sovereigns, they shape their trajectory, they can have political impact, they affect policy, and they also can lead in different varying ways to potential crises or large opportunities. Increasingly, especially in the African continent, with the permanency and development of the private creditor, they are influencing state behaviour. So understanding their development and better organising for their impact is now of critical importance, because they are now becoming a core financial governance tool. In terms of looking at how this development is now developing as a global system, the system is adapting, not collapsing. The difference in variation in terms of environment around African borrowers is instructing a new way of thinking about credit, and a new way of thinking about how to liaise and understand the world, not only of credit, but of African creditors. So now we're seeing an increased understanding and appetite for scrutiny, for increased regulation, and very much more importantly, for increased transparency. This is still developing, and particularly for the African continent, what that African version of those key elements such as scrutiny, regulation and transparency looks like is still being developed, and that's why we are all here today, as we have another node in the continental mechanism for dealing with this phenomenon. So the challenge today is not about replacing the global financial system or upturning it, but really about how to make it more credible, more transparent, and ultimately and hopefully more accountable. Essentially, this issue of credibility is key, and credibility in and of itself is institutional. So markets in essential, they trust processes and not claims. Credibility institutionally is built through governance and data and reliability and consistency. And one of the unfortunate byproducts of building credibility like this is that it is slow to build, but unfortunately it is also fast to lose. So that is why strategy And conscious development is critical here. It cannot be ad hoc development, because ultimately credibility is not declared. It is constructed through institutions, through standards, and through professional practice. Moving forward, the critical element to get to that end point is that we move away from single endeavours and we move forward towards building key ecosystems. Developing a strong credit rating foundation and a strong credit foundation relies on key ecosystems. And that's why today's launch of this association, and I'll talk about association shortly, is a critical waypoint on this journey, because the aim is to build a sustainable ecosystem rather than an individual entity. Ultimately, in terms of looking at what Africa's opportunity is, I believe this opportunity is institutional. It is not in changing the logic of credit or in upturning how credit is considered. For me, I think it's about looking at focusing on that ecosystem and that foundation, in building consistent and reliable and trustworthy data quality, in focusing all investments and endeavours on transparency and capacity, and bringing together some of the incredible minds that operate on the continent to develop an African flavour of what is a required capability moving forward for the continent. I'm pleased to see over the past number of years, and this launch today is a fantastic example of focused and considered engagement in something that affects every African who lives on the continent, and in truth, every human being that lives on the planet. Credit is a fundamental need as the economies of our societies grow. And in order to make sure that the countries are able to best develop within that system, conscious, positive, and purposeful engagement is now critical. In reality, the future of African sovereign assessment will be shaped less by political positioning and more by institutional quality and professional credibility. It's also, as my work at the moment is focusing on pre-rating engagement, what African countries can do before credit rating agencies get involved. But credit rating agencies themselves and associated professionals also have a very specific and important role in helping entities within this ecosystem best understand their capabilities, their constraints, their options, and strategizing the way forward. So from my perspective, I believe engagement is the next frontier, and focused investment will get us there. That includes structured dialogue, things like appeals and building consistent and positive narratives for African development, and also building a new regulatory cooperation that puts African voice within the global infrastructure of credit formation. So I'll turn finally towards what associations are and what they are not. So it's very critical for an early association in such a very compact field that the purpose is clear. And I think today, as we'll hear about different perspectives and different declarations from the association, it's very critical that this is perceived. So associations really should not be advocates or political components. That is for other members and other components of the infrastructure around credit. What associations for credit ratings really need to focus on is building capacity internally within their members, making sure the standards, training, transparency, and dialogue are central to what they operate, and for building a collaborative future that not only helps sovereign debtors, but can also help creditors and every different component within the infrastructure, including regulators, to best understand what is happening on the ground and to promote that positive narrative. So in closing, the credit future for Africa is simply about trust. Africa will have to participate, and currently does participate, on the global scene. In order to do that more effectively, so we can bring this cost of borrowing down to allow countries to better invest in their healthcare infrastructure and their education needs, it's critical that trust is placed at the forefront of every decision that is taken. And how that trust is developed is simple. It's by consistency. It's by consciously shaping this cost of borrowing down to allow countries to better invest in their healthcare infrastructure and their education needs. It's critical that trust is placed at the forefront of every decision that is taken. And how that trust is developed is simple. It's by consistency. It's by consciously shaping the narrative, and by investing in that future, in the knowledge that with this concerted effort, that investment will bear fruit for Africans not only today but in the future. So with that note, I will pass back to the floor, and congratulations on the launch of this association. Thank you.
Thank you so much, Dr. Cash. That was Dr. Daniel Cash discussing Africa's credit future and how we should be rethinking sovereign assessments in a global context. I appreciate how Doctor encourages us to stop putting all of our hope and trust in politicians and start focusing on institutional quality and credibility. Having institutions that encourage global credit rating agencies to be credible, transparent, and accountable. Thank you, Doctor. Next up, we have our first panel discussion of the day, and moderating the discussion, we have Professor Rajan Pillay. He is the CEO of Garuda Capital, a Santon-based boutique mergers and acquisitions firm specializing in capital raising, complex financial transactions, and strategic advisory services. Professor Pillay has advised the Minister of Trade and Industry on matters of national importance and previously served as Professor of Practice in Financial Engineering at the University of Johannesburg. He has held several prominent appointments, including roles within the BRICS Business Council, the International Trade Council, and the South African Chambers of Commerce, UK. He was also appointed by President Nelson Mandela as Honorary Consul to Mauritius. Ladies and gentlemen, Professor Rajan Pillay. Joining Professor Pillay, we have Sam Omukoko, an experienced credit industry executive and entrepreneur with 20-plus years in credit bureaus, credit rating, and business information services. He is a founder and managing director of Metropole Corporate Limited, which operates credit bureau and credit rating agency services. Sam possesses deep expertise in credit analysis, credit scoring, ratings, risk assessment, and business development across East Africa. Joining us virtually, please welcome Sam Omukoko. Also joining them is Christine van Jaarsveld, an award-winning finance and property specialist with over a decade's experience in residential, commercial, and business funding. As franchise owner of AT360 Finance Sanson, she leads a high-performing advisory practice renowned for strategic lender partnerships and outstanding client outcomes. Nationally recognized with multiple Best Franchise of the Year awards from 2020 to 2025 and top consultant accolades. Ladies and gentlemen, let's welcome Christine van Jaarsveld. Finally, let's welcome Ephraim Chawoneka, a seasoned business executive with over 20 years in the financial and structured finance field. He holds a master's degree in leadership and change management and another one in agricultural economics. He's qualified as an insolvency and business rescue practitioner with SARIPA. He has sat on the boards of financial institutions, stock exchange listed entities, and private corporates. Please help me welcome Ephraim Chawoneka. And we have with us Veli Banzi Mazia, who didn't want us to introduce him as anything else except the Chief Operating Officer at Sovereign Africa Ratings. And that is our panel for the day, the first panel of the day. Professor, take it over.
Morning, everybody. Salutations go to Dr. Falala first for his blazing introductory speech and comments. I think he's touched a few nerves there. But this concept of credit ratings is really deep. It affects our future going forward. It affects the continent's future going forward. It has long-term impacts on economies. I think we really need to put that into a little bit more perspective, primarily because it influences the flow of funds, international fixed investments, where it goes and how it goes. It affects the cost of those funds. And because it affects the quantum of funds, the movement of funds, because investors have choices as to where to put their money. And they've been pushing it into Asia for a long period of time. They haven't been pushing it into Africa for a long period of time. So the impact of these flow of funds and the cost of funds translates to jobs, new projects, lack of jobs, lack of new projects, slow economic growth, and all kinds of macroeconomic effects which can be detrimental if not adequately handled and addressed. Dr. Falala, in his opening comments, mentioned this. We have ample examples of where, for example, you have a good entity. It could be a state-owned entity, it could be a large corporate operating within a particular country. Balance sheet is good, business is good, yet their access to funds and their ability to grow is many times hampered by the country rating, the sovereign rating. So within a poor sovereign rating, there might be instances of good corporates and good businesses which are worth funding but can't get access to money because of the ceiling placed on their rating because of a poor macroeconomic country kind of perspective. So I think when we understand the implications of this for populations, for communities, for project development, then the whole gravity of the situation sinks in. It's not just a talk shop or anything of the sorts. And the thing I think that ACRA stands for is to be able to give the continent a voice in terms of credit ratings. We don't want that biased lens that's been focused on various countries for various reasons. We want to be able to stand up and say with one voice, this is actually the lay of the ground, assess us fairly because of the long-term implications of this. So I'm really pleased to be able to have a wonderful panel here this morning of real experts, people who are practitioners. They've been on the ground, they've got a lot of experience as to how this topic affects our countries our country's projects, big projects, infrastructural projects. Africa has got infrastructural deficits of hundreds of billions of dollars, so it's under development. And one of the key ways to release that funding is to be able to get fair and decent credit ratings. So I'm really pleased to be able to moderate this first panel. And we have a few experts on the panel with me. We have just 1 hour to traverse the topics. And we have, I think, 4 inputs that we'd like to be able to call on. So if I'm an hour for the panel discussion plus questions and answers to follow. So if I may ask the 4 panelists to maybe just take 10 minutes, give us their inputs, and then we can analyze it and discuss it. Christine, would you like to maybe start?
Thank you, everybody. I always say to the rest of the guys, I'm not the one sitting at the top making the decisions. I'm the boots on the ground. So I work with multiple clients on a daily basis, and I always believe economy is built from the ground upwards. We work in different agricultural, commercial and residential sectors, and trying to get funding to projects that really matters. So exactly like Dr. Pillay said, that I think our key issues that we have in South Africa is really getting the funding to those projects that really matters. Specifically when we deal with agriculture, we've got wonderful funds that's coming up, but the moment they go overseas to try and get funding, they exactly hit by what's happening with our economies, economic situations, as well as situations that differs back to our credit ratings. And those are the things that I believe that this panel can address, and that also ACRA can assist with, so that we insulate ourselves against what's happening economically in our continent, but also helps us to get physical credit ratings down, so that we can have people trust our economy and get money flowing to the projects that really matters, not to just our macroeconomics, but also to each and every individual on the ground that looks after a community or a family. Because if we support macro, it filters down to the micro, and we sit with actual people earning an income and supporting everybody around them.
Thank you very much. We'll do the questions and Q&A session at the end, so if I can just go down this way and start with Dr. Sifiso, you want to go? Mike. Yeah, all right.
Okay. Thank you, Prof, for that. I'll speak both on behalf of SAR as well as ACRA, the association. So from our experience, we have noted that the investing community, especially in South Africa, has a preference for the big 3 international rating agencies. And this has been in place for quite some time. We have seen support for local rating agencies before. I'd make an example out of GCR, which unfortunately now forms part of the big 3 rating agencies. However, I want to speak about the importance of the alternative rating opinion from domestic rating agencies. And this is based on the nuanced understanding of the African economic frameworks that are in place, and the realities of the socio-economics in this jurisdiction. And that really is where domestic credit ratings can come into play to provide a new perspective. And the impact that this has is it provides more information into the market. It also limits, or let me say reduce, the reliance on a few opinions that are based on a select few from the outside. So at the end of it, using domestic credit rating agencies benefits both the issuers as well as the investing community through that extra available information in the market. I'll leave it there for now.
Thank you, Prof. So I will speak from the Zimbabwean perspective. I'm based in Zimbabwe, and I lead an organization called the International Credit Rating Agency. We are licensed by the Reserve Bank of Zimbabwe. We are also cleared by the insurance, the board that is responsible for the whole insurance sector in Zimbabwe. And also we have recognition, in the capital markets with the Exchange Commission of Zimbabwe. Pretty much we cover the sovereign ratings, but we are more active on the issuer credit ratings, active on the ESG ratings, bond ratings, and also the scorecard scoring, where you are onboarding investors or any clients. The motivation really for Zimbabwe more specifically, you would find that it developed a framework for local rating agencies to operate, but it did not have the rating agencies. We are also dependent on the one that Zweli has just mentioned, GCR, which unfortunately is also now part of the big three. The acceptance in the market has been great, more so because there have been a number of questions. I think taking it from the top, you will understand that there are about 33 African countries that have been rated. And out of those that have been rated, that's out of 54. And out of those that have been rated, only 2 are in the investment grade. Now, the other key indicator coming through is that if you look at the top 20 fastest growing economies from 2024 to 2026, where we are sitting right now, 12 of the 20 are African countries. Now, superimpose that to ratings. You will find that out of those 12, they are all in the non-investment grade. They're actually in a junk grade. So you have the fastest growing economies with a junk grade. I think that's something that we really need to interrogate, dissect, and clinically, understand. When you then talk about those fastest growing economies, you are saying, what is the future? Ordinarily, you would expect a steep flow of investments into that destination because there is growth. But on the flip side, if you look at the low growth economies, they're in the AAA rated investment grade. So it's a matrix that is very difficult to understand. And I think the birth of ACRA, comes in to interrogate these issues, get us to understand the contours of information that is sitting in Africa. Because even from an Africa premium perspective, you would find that, I know that UNDP did a study and they said just out of debt servicing, interest, Africa spends around 75 billion United States dollars. And this is in overpriced, capital. And when you look at even the new capital markets that are coming through, especially the green bonds and the other capital markets, Africa's participation there is restricted to 1%. So essentially, there is need to interrogate the data. There is need to present the true story. And I liked what Dr. presented in his opening remarks, that we are not coming or we are not advocating for lower standards. What we are basically saying is that we need to account for every detail, the granular detail. So the domestic or African rating agencies will go down to pick up the granular nuances that can be used in coming up with a rating. For now, that's what I would say. Thank you.
Thank you very much. I hope you're still there with us. Someone said to me, what is 0 times 100? I said it's 0. I hope I was right. And then they said, what is 0 times a billion? I said it's 0. Then I hope I was right. And they said, but how can 0 times a billion be the same as 0 times 100? It's all about numbers. It's about money. Money is not everything, but money can buy most things, okay? And because money can buy most things, we actually need the money in order to build bridges, to construct roads for the sub-sovereigns to provide services. And often there's a shortage of money, but the rate at which they borrow can lead to a further dilapidation of infrastructure. So we then try and say it's important to have mathematical purity and purity in measurement instruments that are being used to represent populations. How do you represent 65 million people? How do you represent 1.4 billion people? There is only one way of doing that. You use data. The problem is what kind of data, and we are here today to ask you to challenge us with regards to what data actually is sufficient to measure African creditworthiness in order to have the money to fix those schools, the police stations, and the universities. So what sort of data is sufficient? Institutions, of course, matter, and I think Dr. Cash spoke about that. And as an institution, we will benefit greatly from your input in terms of pinpointing the economic data that needs to be paid attention to. When we measure various phenomena such as the performance of economies, we actually have to look at the structure of that economy. We have to look at the potential, the resources that that economy has access to. But there are other variables to be taken into account. The question is, as ACRA, the discussions that we will be having relate to the best mathematical, the best academic framework that accurately represents the 1.4 billion people in the 54 or 55 countries on the continent and beyond. The issue of the use of mathematical algorithms in predicting financial outcomes and cash flows within each of the different economies is very important, and to that extent, we rely a lot on external data. As a country, South Africa is fairly sophisticated, and we know this is the case also in Zimbabwe, in Nigeria, in Kenya, where we have members. And for that reason, many of the data sets that go into an algorithm are automated. The automation of the data sets, however, still requires a prioritization or a weighting of each of the various individual variables that are used to determine and calibrate the ultimate sovereign rating score or scale. So we challenge you today, maybe through your questions and your interactions, to work with us in understanding that there is no such thing as a pure or a perfect rating. The rating depends on the number of variables. Some agencies use 20, some use 80, some use 180, but the magic is also in what is done subjectively to moderate or mediate over the score. Also, we know all scores are impacted upon by subjective judgments, for instance, based on current affairs, based on retrospective history. To what extent, if I were to ask all of you, would the history of payment and non-payment be important in calibrating your credit score? Let's say you've got an account, you've borrowed money, and you've paid in each of the last 50 years without fail. What should your credit score be? If you're in a situation where you've borrowed for the last 50 years and never defaulted, but you're in junk status, many academics might actually question the precision of the method that is used to predict that, because the behavior shows that if you were to fit a linear trend line, shows that you are actually more than likely to pay what you owe, and therefore you should not be borrowing at a penal interest rate. You should be borrowing at an interest rate that is friendly. So these are the issues that we would like you to become aware of and to challenge us to think about and to engage in, because these issues determine whether or not there will be lighting in Soweto, whether or not there will be a new clinic in Khayelitsha. And they have a domino effect on governments, they have a domino effect on multinationals, they have a domino effect or a cascading effect on smaller businesses, medium businesses, and eventually they affect the small to medium enterprise. So this is not a small matter. It is a massive issue when you talk about credit ratings, because they run right through the economy. Everyone is impacted upon. That's why we all sit and stay glued whenever the governor of the Reserve Bank makes an announcement of the changes in the interest rate, because in our own small way, that has an impact on us. Can we imagine now at a global rate where you're looking at the sovereign rating? So this is an important discussion, and we thought as a committee or a panel would like to stimulate some of the ideas that might arise. Thanks, Prof. Pillay.
Thank you very much, Dr. Falala. Nice comments. Thank you. Program Director, are we able to get Mr. Sam on the phone? Yeah. Please join us, yeah.
Sam, please unmute your mic. It's okay. Let's move on to the next person. Thank you.
I think we're okay for the panel inputs. I was just waiting for Mr. Sam, but we can go next to maybe some of the further discussions that is highlighted here. So I'd like to talk to what Mr. Ephraim said. I think it was one of the most pertinent comments, and we'll like to drill in down into that. What you said, sir, was that many African countries have got junk status, yet they are the fastest growing. Now, if you're a business person, like we are, you should be guided to say, you'd expect a credit rating to kind of direct you where to put your money. So if on the one hand they're growing at really good rates and yet they're in junk status, something's wrong. And there's going to be a gross misallocation of funds and the flow of funds. So I was intrigued by that comment, and I'm sure the audience would love to know how you could maybe unpack it in maybe just a few comments, what you believe could be the issues around it, and maybe Dr. Falala can come in on that one as well.
Thank you, Prof. My take is that if you look at the methodologies that are employed, with credit rating agencies, they are almost, alike. If you are rating a bank, you are probably using Camel's rating, methodology, for example. And what you put in there as variables are almost similar. If sovereign rating is to come into Zimbabwe, for example, rate a bank that I have rated, pretty much, if we are using almost data from the same source, we should get to a point where we may differ in terms of the symbol that we give, but in terms of the class, it could probably fall in investment grading if I had put it as an investment grading. So, generally, what we expect to see is that there is a negative relationship between growth and credit rating that, gives us, even ACRA, a headache to say, so what really is going on? What builds growth? For African countries, sometimes it's the resources that we have. For certain entities, we've invested so much into services. That's why you see economies being pushed by tourism, for example. So that's a result of a policy that is coming up, which speaks to governance, and governance is a special pillar in credit ratings. So when you put the pillars that go into credit ratings and you superimpose that to growth, you'll find that if the pillars are doing well, there must be some element of positivity when it comes to growth. But it's actually the other way around. Maybe the other way of looking at it is that is it not true that in a AAA rated country, evidently we have seen banks closing? Equally so, in a non-investment rated country, we have seen AAA companies operating, even if you look at their market cap on the stock exchange. So I think there seems to be the element of where is this growth? Is it in Africa? So there is a cap, there is a silent cap that we probably don't see, and that then creates challenges. And when you then want to superimpose and say, okay, fine, low growth, does it then translate to high ratings? Try to impose that to Africa, again, it doesn't make sense. When you then say high growth, does it translate to low rating? It doesn't make sense again. So it's actually putting, this whole issue right on the doorstep of ACRA in terms of, going ahead and trying to find out how that, elephant in the room can be addressed. Thank you.
Thank you, but I don't want to let you go just yet. I think you've given a professional kind of explanation for it, which is not what we're looking for. What I'm wanting to know is actually the unkind interpretation of it. Maybe you can share it with us. So when, given the situation, the person is about to release, or the institution is about to release its credit report, is there no sanity check that prevails? I mean, is that not what ACRA is saying? If you're saying this and actually something else is happening, before you say that, can you please look at it again carefully? I'd like your comment on that.
Okay, Prof, I think you are putting me on the spot here. Well, I don't have all the answers. What I'm giving out is basically a gap analysis, which then serves as a motivator to say, how do we move as African rating agencies? How do we move? And if there is need to correct that narrative, have that corrected. It's something that we can't run away from, Prof. It's happening. The disconnect, I'm sure we'll get to the subject of trust. And when you look at the subject of trust, there are many stakeholders that are involved when you come to the subject of credit ratings. We talk about the investors, but we also talk about the ones that are being rated. Do they trust the system? In certain jurisdictions, you find that credit rating is a compliance issue. And the push, I want to believe, is that we move beyond the element of it just being a compliance issue to best practice, so that any part of the stakeholders that you are looking at, would trust the system. And what the results show is what is practically happening on the ground.
Yeah, thank you very much. Because I think if you consider international cross-border investments, the Asian countries still have an appetite for Africa, notwithstanding the poor credit ratings, etc., etc. So I think it's a tool, but how we use the tool and how we apply the tool depends on who's looking at it. So thank you very much. Christine, I'd like to pose a question through to you. So, in your opinion, do you think stable credit ratings in the African context is possible or can be possible given frequent changes in regime, changes in governments, etc.? Because what happens is that when the government changes, the ministers change, and the ministers change, they change their DGs. So there goes policy certainty, there goes transparency. How do you think this can be preserved given the number of countries and the fact that at any given point in time, at least 3 or 4 of those countries have got some kind of change happening politically?
Thanks, Doctor. I think it's a good question, and again, as we see it happening on the ground very often, is a simple example is you've got certain title deeds that's connected to certain projects, and then when the politics change and somebody else comes into play, they change the rules of how we use certain things as metrics. So I think it can only happen when there's a real data connect. As we said, I think a lot of times we use matrix to measure economies, and we really don't understand what's happening in our economy. If we look at, we've got about 83% of Africa falling in the informal economy sector. And if we insulate ourselves from volatility of what's happening in the politics, we might be able to have a credit rating that sits in a space where we can really determine what's happening, that we have the right data connect, that's checking and seeing that does it make sense? Does the data that we're using really make sense to what's happening on the ground? I just always say drive down the R21 and you would think we're living in 2 different countries. So we have to have that data connect, understand the sources that we have on the data that we're using, but also making sure that exactly the politics that is governing our country doesn't change the way that we use money flowing into our country or having other countries trusting us with their investments.
Thank you, Christine. A bit more of an operational question for Mr. Mazia. From SA ratings point of view, how do you practically maintain independence when viewed with uncertain political or environments?
Right, thank you, Prof. Political stability tends to be a controversial subject in credit ratings. We've seen in the past other CRAs defining political stability in terms of turnover. But if turnover is your metric, does that mean a dictatorship where the regime doesn't change? Does that mean that's stable? It brings about those sort of types of questions. And then also, of course, if it frequently changes, we suppose that could also bring about some instability. So as Sovereign Africa Ratings, what we do instead is we focus on political, we focus on policy predictability and continuity. What this does is we avoid the instances where we look at the personalities, as well as, to avoid any sort of favoritism when it comes to the personalities that are in office. So focusing on policy continuity, it assists in assessing the creditworthiness because that brings about that predictability about what will happen going forward. Also, credit rating agencies have to be independent. And the way we do that is to have a physical and operational separation between the analytical teams as well as the commercial staff. And this is to ensure that there's no rate shopping, there's no favoritism depending on which issuer pays more. And this is also based on the regulation that we comply with here in South Africa. So regulation plays a huge role in this aspect, and it's important for rating agencies that are used, especially for ratings that are used for regulatory purposes, to be ratings that come from licensed and supervised credit rating agencies. We've noted that in certain jurisdictions, they may only license credit rating agencies, but the supervision aspect may be lacking. So I think we are lucky in that aspect. However, it's a two-edged sword because compliance is quite it's quite extensive, and it tends to be intrusive as well, ensuring that all things are always in order. Thank you.
Thank you very much. Program Director, I'm not sure how much time you're going to allow us, but all right, 5 minutes, please, for questions, yeah.
You have 5 minutes for discussion and then 15 minutes for question and answer. Mr. Sam is now able to speak. Sam?
Thank you very much, Director, and thank you to the panelists. Sorry, I've had some technical hitch, so I wasn't able to join in at the beginning. What I need to say are a few things about the creation of the African Credit Rating Association and its launch today. This is a very fantastic idea because it's going to shape the narrative of credit rating conversations on the continent. Because the time for Africa to change its financial architecture and credit risk management systems has actually come. And all I can say is that there's a report that was released by UNDP which noted that in the last decade, African countries have spent about $474 billion in excess interest on their borrowings. This obviously speaks to the question of cost of borrowing, which is a fundamental issue as far as credit rating is concerned, because credit rating helps to lower the cost of borrowing. The other point that I would like to point to is the investor base. Most of the investors are clearly based overseas, but Africa has a clear emerging base of investors, which includes institutional investors like pension funds, mutual funds, and such entities. These entities require a systematic way in which they can be able to assess the risk of the investment opportunities, and credit rating clearly will play a significant part into that. The other point that is critical, again, is the structure of the capital markets in terms of how we deepen the operations of capital markets and broaden the products that are available within these markets. Again, the role of capital markets in mobilizing capital is critical. So all of these are important things that should be happening today. If I can speak from the Kenyan perspective, recently we had a workshop in one of the towns, and the objective of that workshop was to try and find out how can Kenya improve its rating to investment grade rating, because Kenya consistently has been rated at category B, and category B is below investment grade. And that means the interest rate that the country pays is higher compared to similar countries in other places. And we did notice that there are specific things that need to be addressed at the ratings level. The quality and availability of data in terms of how this data is stored, how it is processed, is an important aspect. Our clear credit information infrastructure is important to see how does information flow from the entities that operate in the country to the entities that engage with the borrowing or the lending institutions outside of that. So all of these are factors that will interact with the rating agencies to be able to arrive at what you call an objective assessment of a given sovereign. Of course, you're always looking at quantitative and qualitative factors. Quantitative factors will depend on hard data that is available within the recording system. But qualitative factors will tend to speak to institutional structures, institutional strength. And that touches mostly on governance issues. So again, you find that there has to be considerable input in terms of how well structured are these institutions, how strong are they, and how independent are they in terms of being able to drive and steer policy without easy reversals on decisions that have already been taken. So when all of these are put together, you'll find that then the continent is ready to be able to chart its own path as far as creating a financial system that will integrate well with the global existing financial infrastructure. That's what I can say at this point in time. Thank you.
Thank you so much, Sam. Handing now to question and answers. Who has questions for our panel? Thank you.
Thank you. Yeah, my name is Kagisho Dichabe. I'm the chairman of the FinTech Association of South Africa, and also sit with Prof on BRICS initiatives. For me, it's quite simple. I think we agree that it's all about affordable money and the growth of Africa. And how do we see, the question is, how do we see the role of African Continental Free Trade Area and BRICS on ACRA, and also the affordable of money in the continent? Basically, the role, what could be the role of BRICS and Africa Free Trade in the continent? Thank you.
Thank you very much. What a wonderful question. I think one can answer you by addressing why, even as Ephraim was saying, that some economies are growing, but the rating is not reflecting that growth. There are three reasons for that. And what you've addressed is one of the three reasons, because our trading patterns and the way we develop financial markets and the way cash flows through our economies is largely between us and other places such as Asia, for instance, Europe and the Americas. So the African Continental Free Trade Area is pivotal. It is actually the missing piece. And this links to the second issue, which is the issue of narrative control. ACRA is formed to encourage academics and professionals to write more papers so that we have more data to prove what we are arguing, what we are positioning. At the moment, there are more articles written about African credit rating by scholars outside of the continent. Until, I think the proverb that I started with said something like, until the lions have their own historians, the history of the hunt will always be told by the hunters. So we need to actually have more narratives, more papers, more position statements to make so that when the world looks at us, what causes a growing economy to remain at junk status is simply because it has neighbors that are also in junk status. The way in which these ratings work, they are based, it seems from the evidence of the data, they are based on segmentation. So you might be segmented as a high risk, medium risk, low risk. It doesn't matter how much you shine. If you are in a high risk market, there will be a cap on your performance because the algorithm already predicts failure before you even begin. Now, if I am in Zim and my neighbor is Zambia, my other neighbor is South Africa, my other neighbor is Botswana, my other neighbor is Mozambique, do you think that the ratings will be so high even if all the neighbors that I have around me are not doing well? It will not be, because you are within a market that is generally considered risky. And this is the biggest challenge that ACRA will bring to bear in terms of its narrative. Until we sort out the African continental free trade area, until you can have movement of funds from the Congo to South Africa, from South Africa to Mozambique, until an institution in Kenya can finance a business in Malawi, you will continue to not have control of the narrative. So these are very important issues that you raise. And I think BRICS simply introduced another layer where we continue to externalize the movement of funds between us and other countries. So what we need to be seeing is, are we inward looking enough, or do we consider all money to be externally generated? Because if we are saying that we are in possession of human capital, we have talented people, we have so many people that are educated, why do we always seem to behave as if all of our resources are going to come from the outside? Because that is reflected in trading patterns in the conferences that we engage in. So I think a short answer to that is that the African Continental Free Trade Area is significant, as is the possession and ownership of the narrative.
No, thank you very much. My name is Madod, Mr. Madod Pomoy. I'm from the University of South Africa. I just wanted to check how is your partnership with the institutions of higher learning? I'm asking this question against the backdrop of the geopolitics, where you have seen tariffs being weaponized to the extent that some institutions of higher learning were heavily reliant on the funding that was coming from that side of the world. And because of the weaponization, all of that funding was pulled out. So now if you want to be the drivers and the owners of the narrative, the partnership you have with the institutions of higher learning, so that they can tap into your funding, and then they will then generate the type of the research, because that even when it comes from abroad, they tend to detect the variables that they would want you as the scholars in producing whatever knowledge to follow. So now if you are the drivers, that will then assist in that. So that's the reason I asked that question. But beyond that, there's a thing, Doc, that you put when you were presenting opening around the underpricing. I'm interested, if we are to achieve equality in terms of pricing, is it possible under the current circumstances where the dollar becomes a dominant common denominator when you talk about the international exchange rate? Is it possible really to achieve it under that circumstances? Thank you very much.
Okay, my daughter, you asked a very difficult question, but I'll try to answer it. The relationship that we believe is important between us as an association and the academic world is, as I highlighted in responding to the previous question, which is we need to have a greater depth of literature about our situation. And it needs to span many countries, not just a few countries. And with regards to the funding, I think all organizations need to work together. We have a great deal of respect and support for private business in South Africa and other institutions. We try and have an understanding of where they are coming from and where are they going. And also the regulators that are represented in the meeting today, we interact with them to also establish where are they coming and where are they going. So there are limitations to the amount of research that can be done without funding. And those factors we may not be fully in control of because some of them are bilateral. They are between various countries and various governments, certainly not occasioned by the academic institution, but occasioned elsewhere. Hopefully some of those issues would be resolved. But we do challenge the institutions of higher learning, such as the one that you represent, to do a lot more work in this space, particularly focusing on the automation of modeling and also on the aggregation of data from various sources, especially on the African continent. Because what you find is that we don't have a lot of population censuses are not as frequent, and the population updates are not as accurate as they should be. And for that reason, the economic information that is produced also does tend to lend itself to not being trustworthy. So if we can have research, for instance, from the University of South Africa to say, how do you navigate around an economy where you don't have a continuous stream of data that has an economic impact? For instance, just the basic income and expenditure surveys that should be in each and every market. So hopefully I've tried to address that. It's a tough question, but maybe my colleagues can also assist.
Maybe room for one more question.
Good morning. I'm Antoine Papia. Thank you to the panel for a vibrant discussion. Professor, my worry is who decides on the definition of risk? And what are we doing to define risk ourselves? For example, if your skin color is different to mine, you are at risk, a risk to me. So I will determine what risk to me is. So as Africans, we need to define what is risk for ourselves. And we need to work with that so we become insular in one way, but also we're giving our Africans more opportunity as opposed to pushing this definition onto them and saying this is how you would define risk. I mean, simple. In South Africa, if you live in a township, you're high risk. But I'm the same African that moves to the suburb. I'm less risk. So maybe the definition of risk is critical. Thank you.
I want to just quickly respond to that great comment. Thank you very much. Yeah, I think certain investors are good at this, others are not so good at it. So your question is just so spot on. If you look at the credit ratings, you'll say, I don't want to go to that part of the world. I'm not going to put any money there. Yet money finds its way into Africa and into African countries. So maybe these are smarter investors, or maybe they use different spectacles, or there's a different risk propensity, and we can discuss a lot around those lines. But I think ACRA is fashioned to try and deal with this kind of bias at a ground level upwards and gradually change the narrative so that the people who want to be influenced by it can be influenced by more meaningful and tangible perceptions of risk. So I think that's what ACRA is going to try and be able to do, get better quality information, more information to help define that risk. Thank you for that.
The very last question.
Hi, good morning. I'm Wayne Phillips from Sovereign Africa Ratings. I'm a board member. And my background is marketing and strategic marketing. And I want to pick up on the point about positioning, and ultimately marketing is about the position that you occupy in a customer's brain. And that's linked to the narrative. And the basic reality is that money doesn't exist. Okay? It's not pegged to anything, it's a book entry. And so this topic is about building trust and independence in African credit ratings. And if you look at it, if money just becomes technically a book entry, it's discretionary. So a book entry in the bank is issued at someone's discretion. And it's linked to the ability to repay. And I think it's very important, and then obviously assets sit in the background. From Africa's perspective, there are the resources, the assets, and there is the ability to repay and a repayment history. And I do believe that it's important that we strongly focus on those two pillars as ACRA, and we drive that narrative. The other comment, and it's a comment, it's not a question, it's built on trust. America, at the moment, is busy refinancing their bonds. They're struggling. They're trying to find $9 trillion. They can't do it. Japan has just had a $2 trillion collapse in their bond market. America's apparently helping them out with that. Okay, so I think if you look at it, all of this is built around trust, and it's built around intertransactional belief in other parties. My final comment would be, how much money is flowing out of Africa into, for example, America's bonds, out of the continent, into Japan, bailing Japan out with their bond collapse. So I believe it goes back to, as I said to you, the positioning and the narrative. We can discuss it later, which it's on the agenda, about the informal versus the formal sector and the opportunity that is created by data to underpin our massive informal sector in Africa. So yeah, in summary, I think very important to get 3 or 4 specific narratives and to drive those narratives and to drive the perception and to be proud of what the African continent has in terms of our natural resources, our people, and we can go on about the natural resources. But I think it's very important that we drive that narrative.
Thank you. Can we just squeeze in one last question?
Thank you so much. My name is Nerina Visser. I represent CFA Institute. My question comes to who's our primary target market for ACRA ratings? Is it the ex-continental investor, or should we rather be focusing on our capital markets and our investors in Africa? We understand our continent. We understand our risks. We understand our opportunities. Is that not the low-hanging fruit for us here? As long as we are trying to almost bow down to an ex-continental master speaking their language, trying to meet perceptions from their lens, I don't think this is going to be anything different. But there's already so much capital available on this continent, and as the gentleman has just also alluded, so much of it finds its way into markets outside of Africa. Alongside the African Continental Free Trade Area, we should be investing in Africa. Is that not what we should be focusing on? Because once we also demonstrate our own confidence and commitment to our own continent, then it will attract ex-continental investors as well. But I think if we are trying to only play to the ex-continental investor, I don't think we're going to win. We need to do this in Africa, for Africa, and then let the rest of the world come and enjoy what we know to be the riches of Africa. Sorry, it's not a question, it's more comment.
A wonderful comment too. Any last words from our panel before we move on to our next speaker?
Fantastic. Sorry, what was the name again? Fantastic. The name? Yeah, that's fantastic. I think that's what we've been trying to enunciate and try and articulate that we start with sovereign credit ratings, and obviously we do hope that we get attention from the likes of National Treasury in our own economies. It's often easier to get attention from an outside institution than to get attention from National Treasury in South Africa on the continent. So we tend to be an outward looking continent, and you're right, the ultimate aim is to gain the confidence where African investors believe that there is a lot of value on the continent, and certainly changing the narrative is a part of that. Thank you so much for your wonderful comment.
Yeah, thank you very much for a scintillating morning. It's really, I think we needed probably 2 days to just go through some of the details that have been raised here. So it's a pity, but we'll have a bit of a chance to interact maybe informally afterwards. Thank you to the panelists, thank you to the audience, and thanks for the great content. Much appreciated. Thank you.
Thank you so much to the panel. Confidence starts here, right? As the lady mentioned, it starts here. And if you have confidence in what ACRA stands for, I'd like you to take your phone out, take a picture, take a video, write a statement, something that you've learned here, and let's share this wonderful association with our social media. Let's share it on LinkedIn. If we have confidence, then somebody else will also have confidence in what we stand for. Thank you so much. A round of applause to our panel. As you take that picture and video, allow me to introduce our next speaker, Dr. Nik Eberl. He is a globally recognized brand strategist, leadership expert, and executive coach with over 2 decades of experience across business, government, and international platforms. He is the CEO of SA Champions,
to advocate for the recognition of African race.
Chair of the Future of Jobs Summit, host of the Top Talent Awards and Top Talent TV, and a global SAP partner coach. Dr. Eberl played a pivotal role in shaping South Africa's global narrative during the 2010 FIFA World Cup, helping to deliver the iconic Nation of Champions campaign, which successfully fulfilled President Thabo Mbeki's brand promise of hosting the best World Cup ever. The campaign achieved a record 92% net promoter score and positioned South Africa among the world's top 10 travel destinations. Today, he will be giving us a talk on the currency of trust, how independent credit ratings build credibility, capital confidence, and Africa's financial future. Please join me in welcoming Dr. Nik Eberl.
Thank you, MC, Mr. President, dignitaries, esteemed leaders. Thank you for hosting me, and welcome to the currency of trust. Now, as you know, as you have discussed, markets don't just move. Next slide. Oh, the clicker, wonderful. Thank you. Markets don't just move on numbers, they move on sentiments, they move on belief, and they move on trust. And trust, as you know, is a real currency that determines where capital flows, where talent goes, which institutions survive a crisis, and which leaders are believed the most. So trust is a multiplier in so many ways, and it's nowhere clearer than at the national level. Now, you can hear from my accent, I was born and bred in Germany, divided city of Berlin. I'm a brandologist. I came to this country in 1994 as a lecturer, just before the elections and President Mandela. And I've been consulting to countries and companies on how to build trusted brands. And nowhere has it been more evident than at a very special time, 16 years ago, in this country and on this continent, when South Africa hosted the 2010 FIFA World Cup and used it as a platform to really boost investor confidence and the trust of the world. And it had everything to do with a brand promise made by President Beki 1,000 days before the World Cup, when he promised that South Africa will host, quote unquote, the most successful World Cup ever. And I was the first and for a long time the only voice in the media to actually advocate this brand promise that yes, we can. I was writing for the Business Day, I was co-hosting on CNBC Africa, appearing on Carte Blanche, and was watching the 1,000-day run-up to 2010 unfold day by day. And the success at the time, South Africa didn't have a ratings problem, it had a trust problem. Because the real question that the world was asking is, can you deliver? Can you deliver at scale? Can you execute under pressure, under scrutiny? Can we keep millions of visitors safe, safety and security? And can institutions, the stakeholders, align? Or will they fracture? And the road to 2010, as you might remember, was challenging, all the way from the first load shedding at Coburg to an incident in Iceland. And if anybody can pronounce that name of the Icelandic volcano, I have a special gift for you. Anybody? I believe it's pronounced like Eya Traf Yakokurl. And I'll tell you more about it just now. So 2008, the first load shedding, major load shedding incident at Coburg. We had widespread xenophobia in 2008. There was constant talk about Plan B, such that one of the major analysts, local analysts, actually advocated to move the World Cup to Australia. The global financial crisis that plunged many, many families into misery and demolished their traveling plans. The Bafana Bafana Odyssey, you might remember, empty stadia. Bafana was not performing at that time. There was an attack at the 2010 Africa Cup of Nations hosted by Angola in January 2010, where the bus of Togo carrying the Togo players, including Adebayo, was attacked. And then the ice outbreak in April 2010 of the Icelandic volcano, which stopped all air traffic for weeks. So for 31 days, South Africa was subjected to the most unforgivable audits imaginable. What I'm talking about, the global media scrutiny. Millions of international visitors. There was no margin for failure. There was real-time judgment. And the key was that everybody was aligned. All the stakeholders, from government to business to civic society, the churches, the people in the street, were aligned to making this a great event and delivering the most successful World Cup ever, which I'm very pleased to say collectively, we did earn the highest net promoter score. And this is a real return on confidence delivered in 2010. I call it the 2010 rock. Not only did we earn a 92% NPS from the visitors, FIFA rated service delivery 9 out of 10. If you think about the infrastructure upgrades, the new hotels, the new airports, the Gautrain, there was zero major crime at the venues or visitor-related. A big boost for leisure tourism and obviously business tourism. The business confidence, the highest since the 1995 Rugby World Cup. the Civic Pride Index, which we measured, the highest since '94, and 500,000 new jobs created in the run-up to 2010. The 6 years running up to 2010, 3 million new jobs created because the stakeholders were working together. And the exchange rate in July 2010 all the way up to 7 rand to the dollar. Today, as you know, 16, in fact, as we speak, 16.06, 7 rand to the dollar in July 2010 because of the increase in trust and confidence. Now, the brand promise that President Beki made was very profound because he made it at the end of the previous World Cup, the 2006 World Cup hosted by Germany, and he made it in front of the world and in front of the international media.
I want to say to you, Mr. President, we will host in 2010 the most successful FIFA Soccer World Cup. And we'll keep that promise. Africa, Mr. President, is ready. Africa's time has come. Africa is calling. Come to Africa in 2010.
Now, as you know, it was not just the South African, but an African tournament, an African showpiece for the continent. And do you still remember when Bafana exited? South African fans, Bafana fans, switched their allegiance to another African team. Which team am I talking about? Ghana. In fact, we called it Bagana, remember? And all of this against the background of not only intense scrutiny, but intense, always adversarial criticism from other parts of the world, because in January 2010, this is a report that the BBC aired about visitor safety.
With less than 5 months to go before the World Cup kicks off in South Africa, concerns have been raised about security arrangements during the tournament. Local organisers insist their preparations for the continent's biggest ever sporting event are on track, and that the safety of fans will be a priority. Our Africa correspondent Andrew Harding reports now from Johannesburg.
This criminal, masked to hide his identity, has been boasting to a local news channel about his plans to attack visiting fans. Not for a second will I hesitate. Now a British company is trying to cash in, marketing these protective stab jackets. But isn't this an overreaction? I've come to one of Johannesburg's rougher neighbourhoods. There's a World Cup stadium just down the road, and this is exactly the kind of place that England fans could well end up drifting into, looking for a bar. Will they be safe here?
Yeah, it's safe. Because the police are moving up and down each and every minute.
Do you feel safe here?
Yeah, I'm safe.
Yeah, they must wear this.
You think they need to wear stab jackets?
Yes, they must wear this, yeah.
Why? Is it that dangerous around here?
Yeah, this place is very dangerous, boss.
So the perceptions of the country and the continent being impaired by external sources, but the country and the continent did deliver to this date, the best World Cup ever. There was an independent scoring, the 2010 scorecard on CNBC Africa, on the 10 determinants of delivering the brand promise. And as you can see here, visitor safety at the top of it. So, and not long ago, the world turned their attention to this country and the continent again when we hosted the G20, when we hosted the world leaders, and yet again delivered beyond expectation, because this is what some of the visitors had to say, and you probably saw it at the national address, the address to the nation by President Ramaphosa, the Sunday following the G20 summit, when he quoted these quotes from our G20 visitor experience report. A French delegate had this to say: we came to discuss economic frameworks, but what we will remember is how your people made us feel. Japanese delegates saying that everybody treats us like welcomed family, not foreign dignitaries. A German delegate, your people are extraordinary. I've never experienced warmth and hospitality like this. And an international trade representative saying that in other countries hospitality is a transaction, here it feels like a tradition. So South Africa did make the world feel at home in 2010 and in 25, and I believe going forward. And I would like to wish you all the best, and I believe the time for ACRA to launch this initiative couldn't be better. And as we said, Kinako, the time is now. Thank you.
Thank you so much. Did everybody know these statistics about the FIFA World Cup that was held in South Africa? Were you guys aware that that was the score we got? But we know so many negative things about our country, so many negative things about our continent, yet we know the positive things about MAGA, we know the positive things about Japan and every other foreign nation. It starts with us respecting our nation, loving the good that our nation has, and not just the nation, but the continent at large. As foreign dignitaries said, we are a very good, great, actually, country and continent. What we're going to do now is have a quick refreshment break. So everybody can just go to where we had our welcome breakfast. It will be just a 15-minute break just to stretch your legs, eat something, go to the restrooms, and then we will meet again at 11:35. Thank you. Ladies and gentlemen, we are about to move to the next segment of our program. May everybody please take their seat. We're going to have a networking session after all of this. Thank you very much. Now, if it's still not clear, ACRA is not asking the globe to give Africa blind faith. ACRA is challenging African credit rating agencies to hold themselves and each other to a high quality standard that will make it easier for both local and global players to trust African credit ratings agencies. Next up, we're going to have our fireside dialogue, but let me just let you know of the update on our program. We are on the 11:15 portion of it, the fireside dialogue led by Anne Rutledge. We are moving our refreshment break to the networking session as we have just had the refreshment break. So we'll just move along from the dialogue to the keynote address with Mr. Sam, keynote by Hannah, closing remarks, vote of thanks, and then our networking and our lunch. Is everybody together? Alrighty. Next up, we have our fireside dialogue led by Anne Rutledge. She is a pioneer in credit ratings reform with over 25 years of experience in developing dynamic, fair, and transparent credit assessment systems. She's a co-founding principal and CEO of Clean FinTech, based in Spain, and the CEO of Credit Spectrum, a free market credit rating agency in the United States. Her work focuses on improving how credit risk is evaluated and ensuring greater credibility and fairness in global financial markets. She is a member of the Africa Credit Ratings Resource Platform Councilium, co-sponsored by the United Nations Development Programme and AfriCatalyst, contributing to strengthening credit ecosystems on the African continent. Joining us virtually, ladies and gentlemen, please welcome Anne Rutledge. Joining Anne, we have Ted Maselesele, a qualified chartered accountant with a background in audit, financial analysis, and risk assessment. Ted developed his expertise through training tenures at PwC and Harvard Chartered Accountants. Currently, he serves as a credit rating analyst at Sovereign Africa Ratings, where he plays a pivotal role in sovereign credit assessments. He has been directly involved in major publications, including the credit ratings for Egypt, Zanzibar, Brazil, and Kenya. Ladies and gentlemen, welcome Ted. Joining them, we have Arlene Wilson-Max, a director of Innovative Entrepreneurs, a strategic nonprofit company promoting South Africa as a trade and investment destination and supporting market access for local products and services. With 25 years' experience in business development, trade facilitation, and cross-sector collaboration, she has built her network across Africa, Europe, Asia, and the UAE. A passionate advocate for inclusive economic growth, she was recently honored with the appointment to Africa Chapter Lead for the South Africa Chamber of Commerce, UK. Please welcome Arlene. Next, we have Dr. Euphemia Akpomimi, a senior lecturer at Wits Business School. She holds a PhD in finance, where she established a novel construct to redefine market discipline to be mostly adopted by emerging market financial institutions, instead of relying on the one-size-fits-all definition that is more amenable to developed market economies. With experience in the banking sector, working for the United Bank for Africa, she currently lectures on digital financial services at FinTech, banking operations and risk management, and digital business modules at master's level. Please welcome Dr. Euphemia. Last but not least, Jacques Deby, strategic leader with over 30 years of experience in investor relations, financial communications, and shareholder analytics across South Africa and Europe, proven success in building business growth through talent development, stakeholder engagement, new business acquisition, and strategic advisory services. His expertise spans the IR, ESG reporting and research, crisis communications and capital markets, with deep sector knowledge in mining, property, financial services, and diversified industrials. Please welcome Jacques. Anne, over to you.
Yes, there we go. Thank you so much. This is a very tightly structured session. We all work together. We curated the questions. This is not for me, but it's for the panelists. We're going to first, I think in our original understanding, we looked at every word in our topic and decided that every word mattered, but somehow we anchored the conversation on credibility. I'll just say one thing about that. There was a lot of really great discussion this morning about building credibility and about the relationship between money, credibility, confidence, and local focus. So I'd also like to layer in a little bit of partnership. So everybody on my panel, don't be surprised if I bring that in. Our first question was, international rating agencies still exert dominance over the African credit narrative, but African stakeholders increasingly are challenging what they perceive as systemic bias. Their concerns are often marginalized in global discussions, and it actually happened to me. In a Reuters article, I was interviewed and my remarks were filtered out and I was told they were irrelevant. That was quite interesting. So we all agree amplifying African voices in the ratings process is not only desirable, it's essential. How do we do this? How do we amplify Africa's voices? I'm going to start with Arlene.
Hello. Thanks, Anne. Okay, so I thought about it a lot, and I thought to myself that it's so important for us to get to the nitty-gritty, not the fluffy stuff. And obviously collaboration is essential because credibility cannot be built in isolation. It emerges when stakeholders come together and align around shared standards, shared data, and shared accountability. Now let's look at that. When we look at the stakeholders that we collaborate with, we're all saying rating agencies across Africa need to come together so that we can have one voice. Some countries don't have rating agencies. So we have to look even, like in terms of our short-term strategy, look even more, closer, or start right at the very beginning, because some countries don't have credit rating agencies. So how do we bring them together to be able to collaborate? So we're starting from scratch. And Dr. Falala and his team have really taken on an adventurous space to transform, to communicate, to standardize, to make things happen for Africa by Africans. So I put a few other notes here. We need to demonstrate what we are capable of doing, how we do it, and the impact we are able to create using evidence that is relevant to us as Africa, to strengthen our African statistics agencies. If you go to Stats SA in South Africa, you go to Stats SA, then you go to another agency. If you're working with Black economic empowerment and you need your active population, your economic active population, the statistics are always different. So for me, we need to basically look at collaboration with lots and lots of different organizations. And that's where you come in. We didn't invite you to this conference simply because you're an expert. We invited you because you have a network that can allow ACRA to be able to collaborate across the African continent. So keep that in mind when ACRA starts contacting you and asking you for assistance and support to make what you need happen in the African continent.
Great, thank you. Actually, Euphemia, you have a special question here, and I'd like to keep yours last. Could we hear from Ted?
Thank you, Anne. Good afternoon, everyone in attendance. So with regards to amplifying our African voices, I'm going to speak from the perspective of a credit rating analyst because that's what I do. Again, I just want to emphasize what Arlene had mentioned about collaboration, but specifically with our regulators and the sovereigns that we rate for sovereign ratings as an example. With regulators, it was mentioned in the previous panel that the ease of doing business, especially amongst Africans, is harder than between Africans and Western countries. Speaking again to the amplification of our voice, making it much easier for credit rating agencies to rate not only corporate, but not only sovereign, but pension funds as well, would increase the number of African voices that speak towards our narrative. The collaboration with or between sovereigns and our credit rating agencies would help us with clarifying our narrative or the narrative that a sovereign or a particular transaction would like to speak. Because what we find is that there's limited participation between the sovereigns that we do rate and our credit rating agencies where they accept a rating as is. We are bound by regulation that we need to get communication from the various companies or countries that we rate. So that would be an important part that we'd need assistance from the regulators and sovereigns to, amplify this collaboration. Thank you.
And if I could just add on to that response from Ted. I'm coming at this from a marketing and education perspective, but I'll leave the education question to Dr. Euphemia. From a marketing perspective, it's all about the narrative, and the narrative is about not just owning and shaping the narrative, but participating in the narrative and getting the right noises heard in the right forums at the right time in the right place. And the big three, I used to work at Standard & Poor's, and all the big three are very good at their marketing. They put on events every year, they roadshow their wares, and they're very good at it. And they're sitting on tons of data which they turn into content which then flows into the market. So that's how they've built their reputation, and they still do that today. So I think for ACRA, the challenge is to get in on the narrative, participate, and do that at a local and a domestic level as well as at an international level. I was encouraged at the G20 last year. Those were the right kinds of noises being made by our government at the very senior level.
Thank you, Jacques. Thank you, Ted. So, Dr. Euphemia, you have developed a novel construct of market discipline in the emerging market context. I find that fascinating. You are an example, you exemplify an African voice, articulating an Africa-relevant concept. What are your challenges in getting heard?
Thank you so much, Anne, and thank you everyone here. I think that is one of the significant problems we have, having our voices heard. I think somebody asked the question, where are the academics coming in here? And the major problem, the pain, is that African scholars have the knowledge, the deep knowledge of credit rating. But the insight we have, including the factors they use in their methodology, in African context, for instance, the governance structures, even political risk assessment, even the bias, the social bias within Africa, we all have that. But the problem is, those insights are not getting to the institutions that matter. What are the institutions? The big three rating agencies, the global regulatory body. Our voices are not being heard. What are the challenges? Why? We write, we teach. So one of the challenges I discovered is limited access to the rating agencies themselves. Do we have the capacity to talk with them? Do we have the capacity to sit with them the way we are sitting here right now? Definitely no. Our meetings with them is always on consultations, not collaborations. It's always on information gathering from Africa. Somebody mentioned that somebody from the Western world can comfortably write about Nigeria, while the person has never gone to Nigeria before. So these are the problems. So when they gather with us, it's all about getting information. It's all about integrating our own framework. It's all about what they call the local voice. They just want you to say what they want you to say, not about policy integration. So these are some of the challenges. Yes, another way we'll talk or we'll cry is through publications, right? I developed a framework for market discipline for Africa, for emerging market. How many people read it? Where was it published? Yes, we pushed to make sure it was published in a well-recognized journal, Journal of Finance. But it was rejected twice. Imagine writing a paper for 2 years. So sometimes people give up. You can't write a paper, one paper for 2 years. So sometimes there is high rejection from African scholars. Sometimes, in fact, acceptance rate is very low. The timing. I'm not going to talk about the cost. In terms of you reject, you pay for it. We paid almost like $800 to publish that. Because when they reject the first one, you have to pay to resubmit. You pay again to resubmit. So these are some of the challenges. Another one, where can our voices be heard? Conferences, panel discussions. But it's always happening in the developed world with restrictions to African scholars in terms of travel costs. We know about visa restriction that is going on these days. You get a very reliable conference where you want to make your voice heard. But definitely, despite your affiliation, your visa can be declined. So you're sitting with your information in Africa, not being passing it across. My brother here mentioned limited access to funding. That is another challenge. yes, we can get funding, right? Because we are all depending on the Western world sometimes. Then they tell you what to write. They tell you what to say because it's creating dependency. You are now voicing their concern, not your concern, because they funded us. The challenge. There's also another thing, data asymmetry. Somebody mentioned, sorry, I'm not good with names. They can measure methodology with 100 and something variables, factors, 80, 60, and all that. If from African context, even if you come with some of the highest factors, your data will be declared less rigorous because you're speaking from Africa. I think my brother Antonio has said something like that. So it's actually challenging. Most of the times, all we'll write just sit in the coffers where students cite. Another thing is how many people, your papers get recognition by citation, right? When somebody pulls out a paper to be like, how many citations? 3, 4. It might not be important, right? Now, what affects citation? Antoine mentioned that. Who wrote this paper? Euphemia God's Power. From where? From Africa. What can she write? So it attracts less citation, which now reduces our credibility as well. There's also another one they could call self-reinforcement. They prefer people who say what they want to hear. The system acknowledges you when you say what they want to hear. When we continue to cry about the bias in Africa, the system will limit us. Therefore, our voices are being limited. But I thank God, I'm happy for ACRA. I've never heard about this association. But when I heard about it, I was so happy that, look, it looks like we are coming home gradually. I developed a construct for market discipline. What was the argument? Market discipline, what is it all about? We discipline banks, we discipline institutions. Using what? Ratings. Why are we going to discipline them using ratings? Why we know that some of the ratings are biased? So it means that Africa is at the receiving end. You know, we discipline our banks because we used figures published by the developed world. We use it to discipline Africa. The market is not the same. The market is completely different. So why are we using the same matrix to discipline our own system? Thank you so much, Anne.
Thank you, Dr. Euphemia. Okay, everybody, are you all angry enough? I am. I hear echoes of my own challenges in my own first world credit rating agency work in the past, including deposition work. I hear it. So let's go move to the second question. Local credit rating agencies who are here today struggle not just to compete with the global incumbents, but to operate in Africa. Despite the irreversible growth of African capital markets that Nerina spoke about in her comment, what breakthrough frameworks would you champion to scale these hurdles? Where is the low-hanging fruit? And what are the partnership angles? Ted, could you start and speak to the regulatory and legal challenges?
Thank you, Anne. So in terms of low-hanging fruit, one thing that I have seen in my research for this topic is that the language that we use in our regulation often excludes local rating agencies from certain transactions. Although I can, as an example, write a government or sovereign rating on Egypt, I cannot provide a rating on a corporate transaction without first getting exemption or licensing from the Egyptian financial sector regulator. A more ambitious goal, though, would be mandating dual ratings. I think this is something that has been spoken about at length, that although we do get the global reach and outlook from our big three rating agencies, there's a lot of nuance and granular detail that is missed by not taking up the rating from local agencies. For example, there's specific sovereign risks that may not be articulated in these global ratings. For example, it was mentioned earlier that local rating agencies understand the concept of sovereign ceilings and how that might not apply to every entity across the board in a specific sovereign. Thank you, Arlene. I mean, Anne, sorry.
Great. Jacques, you have a very rich view on channels in which to do this.
Yes, thanks. And I mean, I was involved in launching and crystallizing the formation of the Investor Relations Society of South Africa in 2016, 2017. And I can draw on some of that experience to overcome some of the challenges that I think ACRA faces and will be facing. And I think there's room for collaboration. It's all about collaboration and getting the word out there. The other forum in South Africa, specifically, that I think could be of great use is the Independent Analyst Society, which has been around for many, many years. Now, these are really geared towards the equity analysts, but there is room for publishing of material. There's room for training of the credit analysts. And in that respect, I mean, one of my dreams or visions for ACRA would be to perhaps establish a training academy for credit analysts. One of my clients last year celebrated 21 years of a training academy for the equity side. And those graduates, 35 of them have gone on to become excellent analysts or captains of industry or business leaders. So I think on the credit side, that is potentially something that we could look at. And I think that that's an avenue or a forum that could produce rich, well-trained, quality analysts on the credit side. And yeah, I think that there's room for collaboration in South Africa. I speak specifically around my market exposure in South Africa, but I think that similar forums may exist in the other major African capital markets as well.
All right, thank you, Jacques. And Euphemia, I'm going to put you on the spot here. One of the things that I did in the past was to teach structured finance because it was not well understood in the West. And I found that universities were a great place to actually see that, that kind of knowledge. Do you, in following up with Jacques' comments, do you have a sense of what could happen with university and market institutional partnerships?
Thank you. And actually, I think, just as I said earlier, the voices will be heard most from the universities. We talked about training. Where is it coming from? But before I go into the thought leadership from universities, I want to make a point that one of the problems is that Africa is like in a credibility trap where we need deals from the market, right, to get credibility. And before you get credibility, you must have access to deals. So it's like we are having a bootstrap problem. So how do we come out from that? Thought leadership is important. But before then, I want to throw something to the market or to institutional investors. If we stand and wait for credibility to come on its own, remember, you need market record, you need track record. Definitely Africa is still growing, we don't have that. Why not we come with balance sheet strength? We talk about capital adequacy. I'm a regulatory person. We can build credibility by recapitalizing local credit agencies. So we can build our credibility from there. From there, we now go into thought leadership trainings, publication. I think Ted is into that, despite he's coming from the industry. It looks like he even writes more than us. Publishing rigorous papers, articles on the issues at hand. Even if the voices are being limited, I think one day it's going to be heard. Using African data, African narratives. I know in finance, in ratings, we talk about the numbers, the quantitative. It's like there are no qualitative aspect of it. But when we come to Africa, there are qualitative concerns we disregard. And definitely these rating agencies are not that. Why not we leverage from the qualitative voice of Africa? Because there are so many metrics that are not working, while in Africa they are hidden under qualitative. So why not we leverage on that? Even if it's not going to be recognized, ACRA is here now. We have to push it out. You know, we can develop some indices, some benchmarks that can speak to African market, that will form African market infrastructure. Somebody asked a question from FinTech Association, right? We can develop these benchmarks to speak to what we have. Despite Africa is at the receiving end, look at the influx of innovations. Look at the influx of FinTech in Africa. It's so massive. Kenya, look at what M-Pesa is doing there. I know South Africa slugged a little bit, but picked up the market. Look at what is happening in Nigeria. We have to develop indices, metrics that speak to those innovations, that will measure our own market by ourselves. These are some of the things we can do. We can pilot research. We can redesign our own methodology. I know it is difficult to critique those three big, but we can launch our own methodology to correct that narrative. Africa is risky, right? It's very risky. That is the only thing, the only voice we hear out there. I think we heard it here. South Africa is not safe, it's safe. Africa is very risky. But we forget the finance theory that says the higher the risk, the higher the return. It means if we are so risky, the return is here. So we have an advantage. We have information advantage to fight this battle. We can train analysts, which is what he already said. We have the capacity. The first speaker said, Africa is rich in skills. You know, we have something like an ecosystem. My colleague said it all, collaboration. Ecosystem of having the university in place, having the industry in place, rating agencies. We write, we talk, we develop our own model, we develop our own indices and benchmarks that will speak to African market. Thank you.
Thank you. So, Arlene, you're next, but we have your question coming up as well. And so what I would ask you to do, just in the interest of time, is to answer that, but also to be me, because you're a bit stricter than I am, and ask the other panelists what credibility really means to them. Would you do that for me?
Sure. Thanks, Anne.
Thank you.
I'm just going to quickly suggest tactical priorities to regional strengthening. You know, one of the experts mentioned that we always go to the Western spaces to look for funding for Africa, for African initiatives, for Africa rating. We have some very, very wealthy Africans in the African continent. Why is the first place we go the Western side? So I would like to see ACRA change that. Let's approach the philanthropists. Let's approach the wealthy African organizations, Nigeria, Ghana, Kenya, South Africa. Let's approach them. The second thing is training. We're talking about how important ratings are. Do the officers at National Treasury in the African countries understand how important ratings are? Municipalities, state-owned enterprises, do they understand the importance of credit worthiness and those types of frameworks? So for me, those are the tactical priorities that I would like to see ACRA look at, is roadshows. And we can do webinars. We don't have to waste time looking for sponsors to pay for food and venues. We can do webinars and really make a big impact, like Jacques said, across marketing. Now, I would like to ask each of you a question and your opinions on what you think is important in terms of the credit ratings. I'll start with Doctor.
Thank you so much. I think credibility is the watchword here, right? And it's not like we don't have credibility as a continent in terms of rating agencies, but I think we were denied of credibility. We have it at our own level. And so I'm sorry for calling your name so much. You know, it depends on what credibility is, who defined it. And it's all about, for instance, whose assessment is being accepted here by the regulatory bodies, by the market, right? If your assessment is well accepted, it means you're credible. If my own is rejected, it means I'm not credible enough. The problem is who defines the credibility. Thank you.
Thank you, Arlene. So credibility, especially for ACRA and the credit rating industry, in my view, a lot of the credibility would be built by a concept called market efficiency. What market efficiency means is that there isn't any room for any, for lack of a better term, fudgery, where one can hide underneath. So when you're looking at ACRA and how they can assist African credit rating agencies in building that credibility, we look at operational efficiency and informational symmetry. Now, with operational efficiency, this relates mainly to the standardization of our rating methodology and processes, because the idea is that if we use the same sort of pluses and minuses, we should come to the same conclusion. Again, with information and data symmetry, I think Euphemia had mentioned this, there's a big gap, especially in Africa, when it comes to the access to information. There's a lot of, especially even on our more recognized or renowned sources like your IMF, you'll find sources of data from 2014, which is quite funny. But with regards to our informational symmetry, the idea is that, again, a rating agency sitting in Zimbabwe and a rating agency sitting in South Africa who rate the same sovereign should come to the same conclusion about the creditworthiness of that sovereign. What we'd like to see, or my goal, especially for ACRA, is the convergence of the ratings that we see out in the market. We always see that there's 2 notches or 2 notches down or 2 notches up between our ratings. And although it goes to, you know, strengthen the independence of your own rating, it brings about the question of how those ratings are comparable between credit rating agencies. Thank you.
Thank you, Ted. Go ahead, Jacques.
Thanks, Arlene. Yeah, I'm going to come at this from a data point of view, and I think Dr. Falala mentioned it in his opening remarks. I think everybody is talking about AI and how that can be utilized in whatever context that business is being run. And I saw a cartoon earlier this week on one of the main financial publications where the CEOs around the world were saying, you know, we need AI. And then the question was, well, what do you need it for? And the answer was, we don't know. Then the question was, when do you want it? Now is the, you know, it's that kind of chicken and egg situation. But I really do think that everybody in the AI world is talking about agentic AI, which is about modeling and shaping AI for your specific purposes and building credibility around the data that is being used. The old equation of rubbish in, rubbish out still holds in that respect. So it's a question of, you know, improving. So credibility is something that is built over time. And it's proof of the pudding argument. You know, you've got to consistently deliver context-specific ratings that are more accurate based on richer quality data, and you've got to do that consistently, and that's how you build credibility. So I think there's room in this context to start the AI conversations. I know that the big 3 are already well down that road, So the train has pulled out of the station, and I think that that is a topic for hot debate in this context. Thanks.
I agree. And I agree with all the panelists, and I'd like to hand back over to you to close our session for us. Thank you.
Thank you so much. I see a question, and you can raise, we have time for questions, or do we? I have to ask the
Yes, we do have time for
the
questions.
organizers. Good, 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 good. So this, I think this was a fabulous discussion. I think you got some highly professional views in very different places. And I think that we have probably done for ACRA, we've probably laid out enough topics for, a quarterly magazine for the next year or 2 years with everybody's support. I would like to just close it out with one observation, and that is that Wayne Phillips said, money is nothing, right? And he's right. And if money is nothing, then ratings are nothing. Ratings become something because people deliver on their promises. And people deliver on their promises in many different ways, and they make promises. And the strictness of those promises, this is cultural. All of us who've worked in rating agencies know this. But the question is, how do you measure it? And I want to say that most of my work after I left Moody's Investor Service was in holding Moody's to account for what it said it did. So I'm here to affirm what everybody has said, that there is much room for innovation, there's much room for training, there's much room for skepticism, there's much room for pragmatic, tactical development, but the partnership angle that ACRA has brought us all here today is very important. I'll shut up and let the group talk.
Okay, we'd like to take some questions from the floor. I see Nomahlubi has a hand up.
Before we do that, the online question.
Okay, go ahead.
My question is as follows. Do you see a genuine first mover advantage for young African CRAs that are not locked up into the legacy scorecards devised decades ago by the Big Three to adopt next generation methodologies and models? Or will the market's demand for comparability with legacy ratings inevitably pull them back toward the traditional templates? I would welcome Anne's perspective in particular, given her work on new methodological approaches, but I'm keen to hear from all panelists. Thank you.
The answer is not only do I think that there is a first mover advantage, but I also think that the comments about the credibility gap and the development of a voice is very important here. You can have the best ideas in the world, but you need support. You need affirmation. You need an educated group to come in and say, yes, this is good and this is why. I think that's why we're all here. And I'm not the only speaker here. If you'd like to ask other panelists as well their thoughts on your question about first mover.
So just to add another point to the question about innovation, especially in the credit rating space. The thing that I have seen, especially with your legacy ratings, is a lack of understanding. I mean, what really does triple B mean, especially to the everyday person? And of course, this may not be the space to mention this, but at Sovereign Africa Ratings, we use a numerical scale. We found that 50 out of 100 makes much more sense than double B to the ordinary person. Just to emphasize or to answer the question, innovation is needed, especially in this space, because while we're looking at historical legacy frameworks, we will reach those legacy conclusions, and that hasn't worked out to positive outcomes for Africans as a whole. Thank you.
Thank you. My name is Nomahlubi Kwinana from the South African Human Rights Commission. I bring the perspective of the human rights lens. Particularly in South Africa, if you look at our constitution, Section 22 is very clear to say we've got this right to trade, but also to choose how we do it. But now, my question then is, whilst we know that in the country we've got a government and of course there are a number of laws. Now how are we making sure, Dr. Falala, that the political will finds also the voice insofar as this is concerned, in order to ensure that you really amplify the voices of the voiceless? Because just as I'm sitting here in this room, and this is what I usually say when I attend these gatherings, is that we always speak to the converted, but we are not bringing the voice of the masses. They are never really heard. My second question is, what is the opportunity for ACRA to address those excluded SMEs? But it still speaks to exactly what I said, the voices of the masses. I've heard you through collaboration, but how? You know, sometimes we speak of things at a high level, and we never get to really just unpack it to an extent that even that ordinary person understands it. I must say that I really welcome the fact that you're thinking about training and, making sure that, there's a space for that, because I would really want to see that so that everyone else is then brought to the fore. My last question then is the regulatory mechanisms. I'm just asking myself, who is regulating all these agencies? South Africa in particular, do we have an instrument that you are already using? Or it is that, it's pick and choose? I'm hearing the CA there, Ted, he says, no, we use this system. Somebody else says, no, I'm thinking that system. But do we have a specific methodology that we can adopt and say, this is the one that we are definitely going to go with? Thank you so much.
Are you addressing your questions? That's the whole world. Thank you. This is the world we're trying to converge upon. Who would you like to address your questions?
Any of the panelists can weigh in on it, but I would also love to hear what Dr. Falala is saying about this, because whilst we are looking at ACRA, it would be important to understand that what human rights lens they have in mind. Thank you so much.
Thank you. Human rights are critically important. And it's very nice to have a person in the room that represents the aura of human rights. The problem you have is that you have different sections of the population that are structured to work together to produce a desirable outcome for the greatest number of people. And one of those sections that you mentioned consists of national government, or provincial government. We as a business and as an institution, we have different KPIs, key performance indicators, and based on those key performance indicators that we have, we may arrive at a different conclusion to the conclusion that national government, based on their KPIs, might arrive at. And therefore, what is important is a convergence of key indicators of success. And I think that's where the problem is. We don't agree on what are the key success indicators. If there could be a convergence, I think then we could begin to find pathways of solving that problem.
Okay. Thanks for the questions, Ramatlubi. So, finding ways to incorporate informal economies, I think we just basically need to think outside of the box. With these informal economies, who wants to become formal with all of the challenges that formal businesses experience? And if you look at Christine with her boots on the ground approach in the rural areas, in the townships, I think we really just have to get together as a meeting of minds and think outside of the box. And how do we bring in collaborating partners who can motivate and influence the changes that are needed. And these collaborating partners extend to the different departments and ministries, to private sector, to incubation hubs, right across the country, right across Africa. That's why I said you've got a very, very big adventure ahead of you, because just looking at South Africa as a country alone, the challenges of incorporating the informal sector into these kind of discussions is extremely complicated, and yet can be extremely simple if we get it right.
Thank you, Commissioner, for the question. Just to answer you in terms of like the different regulation, in South Africa, for example, we have the FSCA that governs the financial sector. In Egypt, I forget the full name, but the abbreviation is FRA. So I cannot, as a South African credit rating agency, just operate in Egypt without being licensed by them. And these are some of the barriers that we find in trying to get that competitiveness or competitive spirit between the credit rating agencies in Africa, is that there's a lot of red tape between what I am allowed to rate and what, for example, someone who is at ACRA is allowed to rate. Thank you.
Thank you so much, Ted, for actually mentioning that. That's quite a complicated thing. We have regulators that guide all the rating agencies, both in Africa and globally. But the major problem we have in terms of this voice is that some of the regulatory policies, agents, bodies are already captured. That's what we call capture theory. That's what we call capture theory in regulation, where the person I'm regulating is the one directing me on what to do. So when we have such problem, it is difficult to hear the voice of the regulators openly. I'm an academia, right? So there is regulatory capture. We are the 3 big rating agencies already telling the regulators on what to do. You remember, Basel is based on them. If your company is not rated by Fitch, Moody, you think you're going to get access to credit, because regulators already said we are going to use those people, because those people already captured our regulators. And this is what we want to avoid in Africa. ACRA is here to solve that. So we have to have that ecosystem speaking among ourselves. The regulators will be there. Fine, we need them to give us guidance. The academia will be there. ACRA will be there. Rating agencies will be there. Then we work together to carry the voices of the low masses. You remember I talked about the qualitative voice. That is where what is missing in the matrix. I was talking about financial inclusion in one of my class. And yes, I actually threw that to know what the students would talk about. They told me, this will not work in South Africa because we have other avenues of measuring our financial inclusion. You remember our stock files. You remember our, I think different countries have different names. People are financially included in different ways, but the ones we know is having access to financial institutions. And if Africa does, or South Africa doesn't have access to financial institutions, doesn't mean that we are financially excluded. So that is where we want our regulators to work with us, not we capturing them and telling them what to do. Thank you.
May I add something here? Jacques, after you.
Yeah, please.
But
yeah, we've been listening too much now. Can I talk? I really want to talk.
Please.
No, please go ahead, sir.
Yes, please, I should.
Yes, you should.
Yeah, and I want to start in a very, very controversial way, which is that we either abolish rating agencies or we deconstruct them. Right? Because these rating agencies, in themselves, intrinsically, have got double standards. And I'll make an example. I lived in Paris for many years. Oh, by the way, I'm less thinking, I'm a sociologist. So I'm not kind of a business type. I'm a sociologist. So I lived in Paris for many years. When they strike in Paris, France does not get downgraded. The rates are going high. When there's a strike in South Africa, by COSA to our civil society groups, our human rights groups, we get downgraded, right? Yet we are talking about democracy. Yet we are saying that we need to build structures of civil society who should be able to protest on streets and do all these things. We get downgraded when we allow our citizens that right to protest and to act in whatever way they are. In America today, as we are talking, America should be downgraded now. Because there in America now, in Minneapolis, people are dying. They are being killed, shot in the streets. They protest in London. People are going on protest for simple, there's no downgrade there, no downgrade. Have you seen any downgrade? There should be a big downgrade now.
Thank you, sir.
So I just wanted to point that out. So we either have to think about this very specifically and stop being hypocritical and be real about the issue.
Thank you. Well noted.
Good. Well noted. And also, if I may, since I'm here in America, I would say that there certainly is embedded bias. The one message that I want to bring that is not my message, it's actually Dr. Sam's message later, is that Africa does not know the entire risk architecture that rating agencies use. You only know the one that's been used that puts you at a disadvantage. The structured finance market that led to a global financial crisis where ACRA and African intellectuals and academics would do well to study that case history, because it is a living case history of contradiction and anyway, I won't echo the last questioner's words, but the point here is that structured finance does not look at the balance sheet. The balance sheet segments the world. You're a mature company, a mature country, you have a strong balance sheet. You're a growing country, you have a weak balance sheet, you're going to have a weak rating. Structured finance goes past that to look at cash flow generation. And cash flows are cash flows. A dollar is a dollar. So I would just want to say that there are things that are worth looking at, look at them holistically, and get informed about ways to use the existing architecture, innovate around it, change it, but look at the whole architecture, not just the part you've been shown.
Thanks, Anne. Just to build on that, I would respond by saying, if you look at the data is unbiased. The data doesn't lie, right? And I think we must be careful about not conflating individual credit scoring of citizens with capital flows that go through institutions and governments. It is a complex question, and I don't think we can answer it now. But I think there's a tendency when you talk about human rights and citizens' rights and constitutional rights, etc., to conflate the two. Credit rating agencies is all about the cost of debt and the cost of capital, and a dollar is a dollar, as Anne says, and the data doesn't lie. So when you talk about methodologies, you talk about how do you build the model, and which model and methodology is context specific and apt and pertinent to that specific context and country. Very complex question. I'm not sure that you like that answer, but I think we must be careful about not conflating the issue.
Thank you so much. My name's Dr. Mark Nasila. I'm a chief data officer in the financial services. I'm also the author of the books African Artificial Intelligence and the latest published Mastering Sovereign Artificial Intelligence. But I want to maybe just give a comment and maybe get comments from the panels. I do think sometimes we need to get a balance between identity and strategy. And I feel this is the biggest gap that is today facing, or the root cause of the challenges credit agencies face, as well as the same we're seeing with the field of AI, especially in the African setting. Because sometimes we strategize more and forget that strategies should be anchored by identity. And in a nutshell, identity is why and who we are. Well, the former Secretary General Kofi Annan once said, to live is to choose, but to choose well, you must know who you are and what you stand for, where you want to go, and why you want to get there. When you look at credit risk, it's especially in African countries, it should be more based on the reality countries face, how we create value for citizenry or even customers, but also how this value evolves within society. And I think there's always going to be that misalignment if strategy is based on a wrong identity. When you look at where the world is today, credit ways of doing things are not just feasible. They sometimes do not cater for the reality people face. They do not anchor and stabilize a reality. If you look at, for example, Stockwell's, we've talked about the informal setting. It's just not realistic. How do we actually bring in an identity so that we can shape the decision making around credit, drive inclusion? There's a company in Canada called Sifiso, which, for example, today leverages rental payments to drive affordability. Mm-hmm. And if we don't do this, we're going to always have a big misalignment. I think it's important that identity anchors everything so that we can strategize constructively. Thank you so much.
Thanks very much. I'm Professor Alistair Mokoena from the Joburg Business School. I just want to speak about technology for a second, if you don't mind. Dr. Falala earlier on said that there's a shortage of data in Africa. And I think you just said that data doesn't lie. But data asymmetry is a real problem. And the lack of access to data that would reposition Africa and drive a reappraisal of Africa away from the notion of a business case to a business opportunity relies on data. Data, many of us like to think, is the sole responsibility of universities. I want to challenge that today and say technology democratizes access to data generation. Africa has 1.5 billion people today. 40% of us are on the internet. That's about 600 million Africans. That's the same number of mobile subscriptions on the continent. Africa has 600 million cell phones. If you have a cell phone, you have GPS coordinates. If you have GPS coordinates, we can find you, we can locate you, we can get data out of you. About 20 African countries haven't done census collection in the last 10, 15 years or so. That's a real problem. But Google has introduced data commons to solve that problem. They've got data from 194 countries that are used by 2 million policy planners. So data is there, but the real issue in Africa is Africa's economy is not formal, as we know. Why is that? 90% of African businesses are SMEs. We're not going to solve the formalization of business, but we can use technology to accelerate the availability of data that will drive the reappraisal of Africa and influence ratings agencies. Ratings analysts use technology today. Digital transformation has permeated every part of society. Your planning, your research is on the net. Every single African has a responsibility to contribute data. AI is a vehicle, data is a fuel. You will not find data on Africa if Africans don't put data. You will always lament ethical issues about AI. If Africans don't generate data that positions Africans favorably, Africans are contracting, they're transacting, they're doing business. The role of the African Continental Free Trade Area to unite all 54 member states to create a single market is super critical. But equally important is the creation of e-commerce on the continent so that Africans can transact with the rest of the world. When you speak to small businesses, and the guy from the FinTech Association will tell you, when you say to a small business operator, here's a payment portal so that you can deal with payments, deal with issues of crime, some of them don't want to touch it because they don't want to pay tax. But let the fear of tax pale in comparison to access to global markets. And I think that's where the challenge lies. So my message is every African must generate data so that nobody comes up with the excuse that I don't have enough data on Africa. And the data that I have on Africa is based on structural shortages because as we know, the Digital Readiness Index that's done by Cisco every year tells us African countries are number 72, going to 147 out of that index of countries. The rest of the world is ahead of us. The number one country in the world, Singapore, 200 years ago, small fishing village of 14,000 people. But they use technology to drive reappraisal. That's what Africa needs. Thank you.
We are running out of time. He's had a question.
Can I respond to that, Katlego? In South Africa, every person who has a cell phone is generating data. The AI companies are, wherever they are, whether they're in India, Singapore, South Africa, are looking at cell phone data as much richer databases and data sources than the banks. Why? Because the lower LSM segments of the population, even in the grey economy, sometimes those individuals have more than one cell phone. They don't have the bank account, that the banks can share data on, and that's why that is the data that's being used. Everybody who uses the internet, that they are generating data. So that is well known amongst the AI community, and I think you're absolutely right. That is where where it's a great leveler, and the access to those data sources is what's going to change the modeling.
If I could, do we have more questions? Because.
Okay. Hi, my name is Ashley Mama. I'm the chairperson of Eagle's Eye Business Chamber. Mine is a short one. I just wanted to find out from the panel. With regards to ACRA, firstly, congratulations to establishing such a profound movement. I have a different view towards my colleague. I do think it's necessary. However, I wanted to find out from the panel, how do you guys distinguish yourselves and from the other rating agencies, besides having an identity to say that this is an African credit rating agency? Second to that is that how do you ensure, I just want to have an understanding, how do you ensure that indeed this rating agency, should it be successful, would not be captured by the powers that be? Because in Africa, as we would know, that colonial legacy is still strong and the colonial ties are still strong. So how would you guys not be captured and this does not become a theoretical exercise and an intellectual gymnastic session amongst our colleagues here? Thanks, I'll keep it at that.
You're going to get 5 different answers.
Thank you very much for that. I am, as in, we are not afraid of being captured. You'll be pleased to know that we sometimes dream of capturing the capturers. There are very few people that consider that, but I have a dream and a wish that I could capture them. And maybe one day it will become a possibility. And apart from that, we're not the sort to be captured. We're not capturable. And then ACRA is an industry association. We represent member interests. There are several ratings agencies that are represented here today. They each have their own methodologies which comply within the regulatory framework. So I think that answers your question about how we aim to become competitive. I think Ted did mention on behalf of one of the member companies, Sovereign Africa Ratings, that already they use a numeric scale as opposed to an alphanumeric scale, which is something that even the global three are not using. So Africa has relatively new agencies, and for that reason, they are able to disrupt. And Africa does need that type of approach. Thank you.
Thank you, Doctor. I know that there are like 10 more questions. We're going to take the last one.
Okay, no, I'll be quick. No, I just wanted to make a note on the issue of the credit rating agencies. You speak of the big three. In finance, we speak of the big four. Your Deloitte, your Pricewaterhouse, you Ernst & Young. And I also comment the work of ACRA, because we are bringing in a different school of thought. You are amplifying the voice of the masses. I think that's what my brother spoke about when he spoke about the domestic rating agency. But how do you then thrive where there is big three and big four? Your voice, how does it get prominent when you know that if I'm rated by the other than the big three or other than the big four, whatever rating that is coming out of there, it won't be really taken serious in the market. I think that is where the core of the problem comes from on our side. And I think the issue that we talked to at the beginning around funding, because those who fund us, they give terms and conditions, and then now they start to determine how I should write, and then that which you want to bring to unearth, that different school of thought, it does not come out because already the terms and conditions are determining and telling me the direction I should take. So the issue that was already enunciated to say, let's have our own funders so that we are able to realize this dream. I think it would assist a lot. But indeed, multiplying the voice of the multitudes is necessary really to grow and then have a different thought altogether. Thanks very much.
Thank you very much. Anne, last words, please.
I think that all the wise people have spoken before me. Thank you. This was a very lively panel, and I hope that it served ACRA's goals of bringing us all closer together and building credibility.
Thank you. Thank you so much for the fireside dialogue. Thank you to our panelists. We apologize, guys, for not having the time to take all of your questions, but we are running behind schedule. Next up, we are going to welcome back onto our screen Sam Omukoko from Kenya, this time with a keynote address on how structured finance ratings can help African countries to achieve investment-grade ratings. Mr. Omukoko, over to you.
Thank you very much, and good afternoon to everyone. It's a real pleasure to give my keynote speech to this congregation. It's a historic thing that's happening here in Africa on the launch of the African Credit Rating Association. And from the East African perspective, I have a few comments that I would like to make. Now, we have all heard this morning the impact of credit rating on capital mobilization on the continent, lowering of costs, and obviously deepening our financial markets. And one of the key critical components is that how do we develop an investor base on the continent? Because that base then will critically understand what the African rating agencies are talking about, their methodologies, and how they can interpret the ratings that are being given to make informed investment decisions. Now, as far as sovereign ratings are concerned, it was mentioned this morning that out of the 54 African countries, 33 of them have credit sovereign ratings, but less than 6 have investment grade ratings. A UNDP report that was released some time back did mention that in the last decade, the African countries have paid in excess of $474 billion in terms of interest expenses charged on their borrowings. This is a colossal amount of money that would mean that it is critical for African countries to address the issue of their sovereign ratings. Why do we have so many of the African countries with below investment grade ratings? And what can they do to actually improve their ratings so that they can lower the cost of accessing credit? Last year, here in Kenya, the National Treasury did organize a workshop specifically to address how Kenya can improve its investment grade ratings. Kenya has always been rated in category B. It moved from B plain, B plus, B minus, and it has various external borrowings from the Eurobond markets and also from IMF and World Bank. And if you look at the interest rates that Kenya is charged on its borrowing, it is significant. Yet, if you look at the historical credit performance of Kenya, it has never defaulted on any of its obligations. So why does it remain below investment grade? So those are questions that basically we're trying to look at. And where do we find an answer to that can take us to the path of improving a sovereign credit rating? One of the parts that I would like to discuss this afternoon is the structured finance ratings. Can structured finance ratings impact sovereign ratings? Now, I need to make a difference between what structural finance ratings and sovereign ratings are. Significantly, structured finance ratings are quantitative in nature. They are cash flow based. It is about identifying an underlying asset and looking at the cash flows from that asset and being able to estimate its ability to service any obligations that arise that are written on that asset. It could be a road project. So you're looking at the toll collection of fees from motorists. It could be a credit card debt. So you're looking at the repayment from the card holders. It could be real estate. So you're looking at the mortgage payments that are coming from people that are holding those mortgages. So asset structured finance is therefore a systematic way of estimating the cash flows that will be generated by these assets and quantitatively assigning a risk to these cash flows on the basis of which an investor can be able to make an investment decision. And that would mean that an instrument will have to be written out, whether it is a bond or whatever it is. That instrument is the instrument that then will be fronted to investors for investors to invest in that particular asset. So can I share? Yes. So I would like to share some critical observations under this structured finance discussions. So can structured finance improve sovereign rating of a country? You're putting this question in a way that in terms of a diagnosis and a prognosis, that the direct answer is that structured finance ratings themselves do not improve a sovereign credit rating. However, development and successful use of structured finance ratings within a country can over time contribute to positive economic and financial factors that rating agencies consider when assessing the country. So the broad way to think about it is that structured finance rating is a diagnostic, an assessment of a specific product, while sovereign rating is a broad prognosis, an assessment of a nation's overall health. The diagnosis doesn't change the prognosis, but the activity it enables can lead to a healthier patient. And here is how it happens. What sort of parameters does structured finance touch that indirectly impact sovereign ratings? First one is in terms of deepening domestic capital markets. Sovereign ratings heavily weigh the depth, the stability, and diversity of a country's financial system. When structured finance creates investable assets, asset-backed securities, mortgage-backed securities that attract domestic and foreign institutional investors, pension funds, insurance companies, the sovereign benefits in terms of the sources and the flow of cash that is coming into the structured finance projects. That deeper, more liquid capital markets make the financial system more resilient to shocks, which is a key positive for sovereign credit analysis. If you look at the second factor, which is improving banking sector stability, we know that a weak banking sector is a major sovereign risk. When you look at securitizations, if you're looking at mortgages, SME, credit cards, and you have debt that is securitized, which will definitely have an impact on the bank's balance sheet. So you are making banks originate assets which are then securitized into the markets for investors. This tends to enable banks free more capital. That freeing of capital creates the ability for banks to create more assets. And this particular activity is important in the sense that it does not put a lot of strain on banks to carry or to have to raise a lot of capital if securitization is allowed to happen. A stronger, better capitalized and more liquid banking sector is less likely to require a costly government bailout during a crisis. This again reduces the major contingent liability for the sovereign, directly improving its physical outlook and credit profile. In terms of enhancing credit allocation and economic growth, sovereign ratings are tied to economic growth prospects and productivity. Structured finance can improve the efficiency of credit allocation by converting illiquid loans into tradable securities. Channel savings effectively to productive parts of the economy, housing via MBS, consumer spending via ABS, infrastructure via project finance securitization. Again, this can support higher and more stable economic growth, a fundamental pillar of sovereign credit strength. It can also help develop underserved sectors like housing, finance, and promoting social stability. The other factor is fostering financial discipline and transparency. The process of securitization requires standardization of loan underwriting and documentation. It requires detailed data on asset performance, defaults, prepayments. and third-party verification by rating agencies, auditors, and trustees. How the sovereign benefits? This raises the overall transparency, data quality, and discipline in the financial system. It encourages better risk management practices across the economy, which reduces systemic risk, a positive factor in sovereign assessment. In terms of managing public debt and fiscal pressures, in some advanced cases, the sovereign itself can use securitization techniques. What it does is that a government could securitize future revenue streams, e.g. tax receivables, toll road fees, or privatize assets through structured finance vehicles. What it does, how it benefits, is that this can provide alternative funding for public projects without directly increasing sovereign debt. It can also monetize state assets efficiently, improving the government's fiscal position and debt profile. One of the challenges we have seen for most of the African countries is the level of debt that many are carrying. Of course, they have not considered alternative financing options which could come through these structured finance options. But if that was to happen, and that would then effectively bring the level of debt to more manageable levels. But there are some crucial caveats that and risks that need to be understood about structured finance. And the lessons of 2008, financial crisis of 2008, are important. One is the systematic risk creation. If structured products are opaque, misrated, and concentrated in the banking system, they can amplify a risk. Evidence of that is now available. We can go through what happened in the financial crisis, 2008, and we can see where the mortgage-backed securities, the weaknesses that they had in terms of banks loosening in monitoring of the performance of the mortgage holders, which later on resulted into a terrible reduction of asset values that the banks were holding. The other one is procyclicality. Securitization can fuel excessive credit booms, subprime mortgages, which lead to devastating busts, damaging the sovereign economic and physical health. There can also be instances of regulatory failure. The sovereign's ability to effectively regulate its structured finance market is itself a rating criterion. Weak regulation is a negative signal. So in essence, structured finance is a financial technology. When used responsibly within a sound institutional framework, it can be a tool for enhancing a nation's financial stability and economic potential. Key ingredients for a stronger sovereign credit profile. In conclusion, the path that structured finance follows to impact improvement in sovereign rating is an indirect path. It is that path that touches on specific parameters that are important when conducting a sovereign ratings that are directly touched by the analysis that is undertaken in a structural finance situation. So the first thing is that if the path is indirect and is conditional, a credible structured finance market develops supported by strong legal frameworks, regulation, and transparency. Are we on the African continent looking at this particular market? Do we understand how it operates and the benefits it will bring to the overall rating conversation that we are undertaking? We're talking about sovereign rating, we're talking about corporate ratings, but we also need to bring into our discussions is structured finance, which looks at projects and product rating. This market deepens capital markets, strengthens banks, improves credit allocation, and supports economic growth. Also, rating agencies in their periodic sovereign reviews observe these structural improvements in the country's financial system and economic resilience. So clearly there is a case for the development of a structured finance market. But speaking to Anne, who is also participating in this conference, she did give an indication that part of what is important about structured finance is that the rating scale that is used for structured finance is different from the rating scale that is used for sovereign rating and corporate ratings, meaning that there is no ceiling that can be imposed on the structured finance rating. You can get the equivalent of a AAA in a country that has a B rating. One of the challenges we have in our country, in Kenya, is that Kenya is has a rating of a B plus. But we have companies like Safaricom, which are big and well established, actually impacting the entire economy. But if you are to do a foreign currency rating for Safaricom today, according to the existing rules, it will have to be either at the level of a B plus or below, because it cannot be better than the sovereign rating. And that brings a lot of challenge, because what you can see and what is being communicated through the rating process does not convey the true story of the entities that you're talking about. And so these are some of the challenges that we need to start dealing with once we are settled down on undertaking the actual ratings that are to be consumed by investors. Thank you very much.
Thank you, Mr. Sam. As you draw to a close, as Jacques mentioned, the big three are serious about marketing, and that helps them remain as the authority in the credit rating space. So please help us market ACRA by posting something that you have taken from this launch, and remember to tag us on LinkedIn. And if you are not sure what to post, here's something for you. Africa may be risky, but the higher the risk, the higher the risk, the higher the. And be sure to cite Dr. Euphemia. Let's not reject our various speakers, just as many publications have rejected their papers. Next, we have Hannah Ryder. She is the CEO of Development Reimagined, an award-winning international development consultancy with offices in China, Kenya, and the UK. A former diplomat and economist, she has over 20 years of experience working across Africa and Asia, including in China, Ethiopia, Rwanda, Nigeria, Indonesia, and Korea. She has been named one of the 100 most influential Africans in both 2021 and 2024, and she serves on the G20 Africa Experts Panel. Hannah is also co-chair of the T20 Finance for Development Task Force and sits on the boards of the Environmental Defences Fund and the South African Institute of International Affairs. Discussing international engagement and collaboration, the role of ACRA and other credit rating agencies, join me in welcoming Hannah.
Hello and good afternoon. It is such a pleasure to be here. Can you hear me okay? Just checking.
We hear you well.
Yes? Perfect, perfect. Well, yes, good afternoon, and thank you so much to ACRA for the invitation to be here. I'm so sorry I couldn't join you in person. I would have loved to. But this year has already started off to a lot of travel, and unfortunately I have to be in London at the moment. But it has been fascinating to take part in this online, to listen to the excellent, very, very deep discussions, wide-ranging, varying interests, and also the excellent innovations that are coming forward. The introduction that was given, I'm an economist by training, and I've been trained to interrogate the sort of traditional and macro and microeconomic analysis. And so that's also listening, for example, to the discussions on structured finance and so on, and risk and return was also excellent. But my role here today is to speak about international engagement and collaboration, the opportunities that ACRA has and the role that it has. And I just want to, first of all, begin with just being clear that from my perspective, at least in the perspective of my organization, Development Reimagined, when we talk about engagement, what we're talking about is influence. We're also talking about agency. And one of the key themes that we work on at my firm is really trying to build African agency. And so the very fact, and I'll come to this very shortly, the very fact of the existence of ACRA now is extremely important and a huge step forward in terms of building agency. So I just want to congratulate everybody in the room and the organizers in particular for creating ACRA and taking it forward. This is also my first speech of 2026, and I think it's exactly the right topic to be talking on, because this year is has already kicked off in a very interesting way when it comes to credit ratings. First of all, in terms of many of you will have seen the news of Ephraim Bank exiting its relationship with Fitch, and which is quite an unprecedented move. And we also will see the launch was last year, but the actual operation of the African credit rating agency in Mauritius will begin this year. So I think this is good timing too, and it's perfect for the ACRA to be really starting to make its own mark in terms of the international agenda and the African agenda. So I want to make 4 key points today in terms of what can be the agenda for ACRA going forwards in terms of international engagement. And when I speak about international engagement, influence stroke agency, I also mean engagement with the big 3, engagement with those who use the big 3, engagement with those who are potential, who use African CRAs, and also with the governments around the world, and also others, including non-governmental organizations. The first key point I want to share is that, and it relates to what I was saying earlier about the importance of ACRA, is that collaboration, especially on the African continent, is key to influence. I want to give you an example of another organization that started just 2 years ago, the example of what's now known as Africa Club, or the Alliance of African Multilateral Financial Institutions. Since AMFI was launched, and it was launched at the African Union Summit in 2024, so we're coming up to the 2-year anniversary. Since that organization was launched, bringing together over 10 African multilateral financial institutions, since then, those institutions have been able to grab and take charge of the narrative around their activity and what they do on the continent. They have been collaborating, organizing joint dialogues, organizing, bringing together more reports and narratives, because they have worked together they have worked out certain narratives which are not in their interests and those which may well be in their interests in terms of building African capital. So they've been able to work together in terms of thinking through joint lines, key arguments, key data, and I'm coming to this shortly, where they can really influence how the rest of the world views them. Now, obviously, decisions like exiting a relationship with one of the big three is a big one for one of the multilaterals. But nevertheless, that comes with the background of having thought about it and even worked and discussed it with several of the other multilateral financial institutions. So I just want to just give you an example of just how important it can be and how useful it can be for organizations to work together. And I think the fact that African credit rating agencies are working together, even if you are having what seemingly feels like diverse interests, or work in different countries or different regions, or work at different levels, whether it's domestic or sovereign, there are going to be key themes, key threads that you can take through and you can actually turn into argument and influence with the rest of the world. Second, my second point is that in terms of engagement and influence and agency, we need to strengthen certain arguments and certain data. What we have seen over the last 3, maybe 4 years is that the big three in particular have started to be more open in African settings. They have accepted invitations to different platforms. They are now sharing more lines and narratives around their own work in African contexts. And while that is, of course, welcome, it is better to be able to interact and understand what is happening with regards to the big three. This is what many African governments want. At the same time, these are platforms that often African organizations are creating. For instance, last year, the African Union hosted the first conference on debt, and I moderated a discussion with several, 2 of the big three organizations, big three credit ratings, and a couple of other representatives there. Now, while it's important to have those platforms, at the same time, the challenge is that the big three do have particular ways that they believe that they are acting in a right way. They will back up what they're saying in different ways. But what we find it hard to do is necessarily interrogate that and even build the capacity of other African stakeholders to interrogate that. And so it requires, a certain level of knowledge of the credit rating landscape, the methodologies, in order to interrogate the big three where they have those platforms. And so in terms of engagement and influence and agency, I think in order for African credit ratings to build the credibility, and there was a good discussion of credibility earlier, in order to build the equivalent credibility, which is what we should be aiming for, if not more credibility than the big three, is really to be able to strengthen our own arguments, to be able to use certain arguments to interrogate and make clear where there are challenges used by the big three and maybe others in the rest of the world when it comes to African data and African ratings. So I think we must, the second task is really collaboration first, then second is to work together to strengthen the arguments and data, whether it's through joint policy briefs, joint analysis, these sorts of even joint lines to take on certain issues could be very useful for ACRA to work together on. Fourth, the third key action for ACRA in terms of engagement and influence and agency is to track what is happening on the continent when it comes to credit ratings. We all know what the ratings are and how biased many are, but more importantly, tracking what we are doing, what African credit rating agencies are doing, and also tracking what others outside of the big three are doing. I've mentioned before in other settings that China, where my firm also has an office, has got 52 domestic credit rating agencies. What do they think of our continent? What have they rated, whether often unsolicited? How have they rated our countries, our firms? How do we engage with them, especially as currencies, as governments try to diversify their currency holdings, and for example, even use panda bonds or other types of bonds? How do we engage with the Japanese, Chinese, all the different credit rating agencies out there, and work with them in order to understand what their issues might have been and how they have solved some of those issues? We may find some very similar points of view, in particular with Chinese credit rating agencies, but there will be others as well. So I think the tracking of what we're doing, tracking what others are doing in a comprehensive way, not being too ourselves biased just to look at the big three, and in terms of working together with others, accompanying, visiting other credit rating agencies in other countries together as a group of African credit rating agencies. And also, for instance, where there are capacity building activities for African governments, for example, UNDP and AfriCatalyst and APRM, who are working on ACRA themselves, they do quite a good amount of capacity building, making sure that the African credit rating agencies are involved and are part of those capacity building workshops in country, so that we build just as much knowledge of our credit rating agencies as those countries will have and member states will have of the big three and the traditional credit rating methodologies. So that third one is to be tracking and to work with others. Finally, in terms of engagement, influence, and agency, our African member states are really critical. There was a reason why the African multilateral financial institutions decided to launch at the African Union Summit. The reason being is to engage African member states on this, because they're the ones that have put capital in many cases into the African multilaterals. As African credit rating agencies, especially at the sovereign level, but also at the company level, of course, we want our member states to really use us, to come to us, to understand us. But more importantly, for our business, there are also key issues that affect us. Some have already been mentioned. Some, for example, the regulations. Could there be, for example, in line with the African Continental Free Trade Area, a joint recognition of any African credit rating agency? If it has a license to operate in one country, why couldn't it have the license to operate in any other? This is something that we could influence African member states to consider. But we can only do that by engaging with them. Similarly, there are certain structures that don't help with higher credit rating agencies. I wrote an article last year on an issue that my firm is working more and more on in terms of concessions. This is the issue where you might find a foreign company that has a really fantastic rating operating in our continent, but our governments cannot have a sovereign rating which would recognize any aspect of that of the operation of that foreign company, because that foreign company has a concession. And these sorts of issues are overcomable. I mean, there is a reason why Botswana has a better sovereign rating, because it doesn't have the same kinds of concessions that many of our other countries do. These sorts of issues brought to member states in a really clear, simple, effective way, where in a way some of the structures that African member states are used to discriminate against ourselves, or where there's an opportunity for member states to be positively affirmative of African CRAs. These are the sorts of issues that we should be trying to engage and to identify what those issues are, and then bring to member states at a political level. This is the opportunity, these 4 areas, the fact of collaboration to identify what those narratives are, the opportunity to strengthen arguments and data, the opportunity and importance of tracking what's going on and working with others, and then last but not least, influencing member states and working with member states actively on these sorts of issues, is how ACRA can make a difference to international engagement. International engagement is not easy. It's a long game. We think about, in our firm, we think about policy change happening within around a space of 4 or 5 years, but 4 or 5 years is good enough. But we can start now. And the very fact that ACRA exists is a really great opportunity. And I look forward to working with all of you. And please do call on us to work with you in terms of this international engagement and collaboration. There's great opportunity here, but we also have to navigate these waters with a lot of clarity, serious vision, but also being very, very aware of where others can also bring us down. So keep eyes open, and we can work together, and we can certainly achieve a great deal of change in these unprecedented times. Thank you very much.
Thank you so much, Hannah. We are not hating on the big 3 rating agencies. We are just saying it's important for us to value and prioritize domestic credit rating agencies, both for the nuance and the local perspective that they provide, as Zweli mentioned. The fact is, it makes no sense for fast-growing economies to be sitting with a junk state rating, while slow-growing economies sit with AAA ratings, as Ephraim said. Not only does it not make sense, but it affects actual human beings on the ground, as Christine mentioned. Now, for our closing remarks, we have Dr. Mmusi Maimane, a South African public leader, reformer, and social entrepreneur committed to building a non-racial, just, and economically inclusive South Africa. He's a founder and leader of Build One South Africa, BOSA, a political platform focused on ethical leadership, youth development, and delivering real solutions for communities across the country. Born in Soweto and fluent in 8 of South Africa's official languages, Dr. Maimane has spent over 2 decades serving in political, civic, and faith-based spaces. He's a former leader of the official opposition in the South African Parliament and previously served as a federal chairperson of the Democratic Alliance. Under his leadership, the DA achieved a historic electoral breakthrough in 2016, winning control of major metros, including Johannesburg, and assembling one of South Africa's most diverse political teams. Please welcome Dr. Mmusi Maimane joining us virtually.
Good afternoon. I hope you can hear me okay, and thank you so much for that kind and generous introduction. I am so greatly privileged to be able to give the closing address at this very, very, very incredible gathering. I am a proud African. I love this continent. The only thing I want to apologize for is not being with you in person. I literally am in transit. I fly out to Rwanda and then to India, and so would have dearly wanted to be with you in person. So I want to apologize profusely for not being there, and apologize to my dear brother and friend, Dr. Sifiso Falala, who is an incredible entrepreneur, a leader in his own right, and someone who I draw such profound inspiration from. My address this afternoon really is to speak about this particular question from a policy point of view and this beautiful continent of ours. Recently, I was engaged in the G7 summit with a number of health and finance ministers. At that question, it became quite clear that governments, particularly governments in Africa, did not have enough financial resource to be able to meet their health and education objectives. As we were having this conversation, a notification came on my phone that told me that the Johannesburg Stock Exchange had performed in the most historic levels that it had ever done. I was then stuck with this dilemma. Here, a stock exchange driven by companies in South Africa linked both here and internationally, we're having record earnings, yet South Africa was trapped in a debt crisis. What that by implication meant is that for every R1 that comes into the South African fiscus, 22 cents of it was going towards debt servicing. You add onto that the premium of mismanagement of resources, you add onto it the premium of leakage born out of budget, and sometimes corruption doesn't deal with the question. Sometimes the issue is just financial leakage that occurs. You can appreciate that that R1, if 22 cents of it is already gone, 38 cents of it goes to cost of employees, the balance of it goes to social welfare. South Africa had no capability of being able to finance its own infrastructural demands relative to the inherent question of why its own stock exchange was doing extraordinarily well. I can remember that question ringing louder and louder in my head as I departed to go to Athens and met with the leadership of Greece. And now Greece as a country had been here as a jurisdiction that suddenly sat and had, when I first interacted with the Greek financial infrastructure, you were realizing that this country equally so was struggling with debt, credit, and credit rating. Yet its cost of capital seemed to be a lot lower in interest servicing costs relative to that of South Africa. And when I met the leadership there, it became quite clear as we shared a panel with the Prime Minister that he started to boast about how successful Greece was in being able to not only transition into cleaner and greener energy, but to be able to begin as a nation in a European context, say to itself, here it is achieving its own developmental goals. And I wondered why that cost there was less in terms of capital borrowing relative to that of South Africa. I contrast these two jurisdictions because I want to at least, if it hasn't been said today, and I'm sure it has been, the burden that is upon your success. I speak as a policymaker in a continent of, in 2040, 1.4 billion people, of which many of those, post the work that Hans Rosling and others have done in factfulness, will find themselves lingering in incredible poverty. The job of any government in Africa is to figure out the best pathways for people who are poor to move to the middle class. And the net effect of it, I always put it numerically to say, the job is to achieve 300 million people moving from poverty to the middle class. Were we to achieve that, it is going to demand the answer to the basic question. What does the over $3 trillion of capital that is seeking a home find its way onto our continent? And it must be rated correctly, properly, so that infrastructural development and the solving of that existential question is being put on the table. And so within that context, we run the risk, as we face many incredible risks, of which I don't need to bore you with those. These are the headaches I have to spend my days dealing with. Is the first, what do we do in financing a continent that has to transition towards a digital economy? We can discuss the use of AI all over the continent, but we dare never forget the cost that is associated with building infrastructure for AI, making sure cooling occurs properly, but then ensuring that Africa itself is able to fulfill its benefit on that score. The second is the question of what happens in defense corporations. It is common cause now that as the United States is taking on a different approach to multilateralism, we as Africa have to think hard about how do we, when we talk about sovereignty, particularly countries that are on the coastlines, and South Africa notwithstanding that, ensures that it has defense corporations to protect its own sovereignty. That is going to require fiscal responsibility to be able to respond to that question. The third, which is perhaps maybe the more prominent, is the question is the question that probably leads to this fundamental issue that as we see population growth and demographics occur in a digital infrastructure, how do we ensure that we manage the burden of disease all across the continent? And this became quite clear when we were dealing even with COVID, about how, in fact, viruses don't require passports, they can move at ease. I put that to you because it is then in the context of even a country like South Africa, where as tariffs are being imposed, as currency fluctuation goes, gross capital formation being suppressed, GDP growth sitting at just over 1%, it then becomes vital that South Africa is able to build its own fiscal response to many of these particular questions. So why then is it crucial that the assets of respective jurisdictions are measured properly, accurately, and being able to give response? I'm grateful that this cannot be a conversation not underpinned by, it has to be underpinned by macroeconomic stability and fiscal discipline. To the credit of our own government, despite its own flaws, is that when a ratings agency comes through and has impact on interest rates, etc., South African government has never sought in other instances to say, well, we're going to disband the responsibility of the central bank. It certainly stuck to it. And so this then is an important baseline from which to operate from, is the role of central banks in being able to keep price stability and give macroeconomic outlooks that are predictable. But having said that, I impress upon you that often information born out of capital inflows into countries is often born out of ratings that are externalized, that don't know how to accurately assess what the nature of the country's, if you like, balance sheet looks like. It is easy to do that for a company, and thus the stock exchange reflects a different story, but it is a different conversation to do that from a country. So, fellow Africans and many who are sitting in this room, this is a crucial intervention that you are spearheading and taking forward. I want to say to you as a policymaker that yes, help us be able to give a sense of sustainable financial stability within the continent by being able to assess accurately and give rating in the continent, so that when we borrow capital, it does not strangle African countries into profound debt and debt servicing costs over a long period of time. The second issue is that as countries are facing incredible climate change, we are in the throes of provinces being flooding, which means that infrastructure build is in high demand. But it also has a profound consequence on our energy supply for our citizens. And here, again, when countries are not rated properly, what we often find is that because of the cost of capital, when investment comes through, it ultimately means that in financing a particular project, the bulk of your expenditure goes towards servicing that debt. And what is more painful is that, as we saw as one of the resolutions that came from COP, is that South Africa now has been able to limit its own coal building capacity in the hope of transitioning into new renewable energy that is costed in a way different to what it should have been domestically. It's one thing to transition from coal-intensive energy. It is quite another to be able to finance for it in a manner that is sustainable both for country and developmental objectives. So what climate change cannot deliver to many African countries is significant more debt, them being left out, and the resources of the continent simply being used in a manner that they've always been, which is the extracting of raw materials and being able to repatriate them back into the continent at a higher price. The burden of climate change, especially in a moment such as this one, requires that the work that rating agencies do in Africa is to ensure that capital is costed correctly and investment is able to be to the benefit of the jurisdictions that is coming from. This is going to be fundamental, as I've been engaged in conversations with many investors here in Africa, none more, people who are coming through and saying, how do we build infrastructure that is correct in so doing, but it cannot be at the cost of countries being left in heavy debt. The ecosystem that you are building is fundamental, because as I travel, I leave here, as I stated earlier, to go to Rwanda, and then later on in the year we'll be in Accra, in Nigeria, and Lagos. If we're going to maximize the Africa Continental Free Trade Agreement, we have to agree on ultimately what the appropriate ratings need to be, not only for the continent, but internally, so that we are clear as to what the cost of capital is. In preparation for this talk, Dr. Falala was having a conversation with the leadership of Ephraim Bank to be able to say, as you are looking to broaden your ratings all across the continent, how do you ensure that ultimately interest rates are calculated correctly, consistently, but cognizant of more factors than just sometimes what is downright patronizing ratings that come through? And it became a very important discussion that the work that you are doing is fundamental and absolutely crucial. If we are to succeed, the first is we have to make sure that the ratings and the reporting that comes from Africa are given as much weighting and credibility as those of the ones that have been currently being used and been benchmarked. We cannot, and just to go on a slight tangent, during COVID, towards the latter half of lockdowns, I traveled to Spain. And when I got to Spain, of course, you will remember how difficult it was to travel during COVID restrictions. And when I got to Spain, the government there ran its own protocols. It tested everybody. I tested negative at the time. And then, of course, for you to leave Spain, you had to produce a similar test that gave you a negative testing. But whilst I was there, the South African community of scientists discovered the strand of Omicron. It then reported all over the world, you'll remember, the strand. And many European countries started to produce lockdowns and shutdowns for any persons who was traveling from South Africa. To which I found it quite bizarre that here we were doing a service to the world, yet the world had decided that your service was actually not crucial because now we could decide to lock out the very respective countries. I arrived back in South Africa. I must concede, and I hope, I know this has been recorded, so I'm careful what I'm saying, that when I got back here, I passed the COVID test in leaving Spain, but when I landed in South Africa, I started to feel a little bit symptomatic of the SARS virus. But the government at the time of Spain then called me a few days later to say, dear Mr. Maimane, you've obviously come back from Spain. We've discovered this virus. Could you kindly please tell us if, in fact, you are showing any of the following symptoms? I promise you, even if I was feeling any of them, I started to just simply say to the Spanish government, look, I'm on a 10-kilometer run as we speak. I've never been fitter because there is no ways in God's green earth you are going to condemn South Africa for having spread a particular virus. And it's in that sense of making sure that ratings agencies do not patronize the reports that come from the continent. We ought to treat what we report on, given that you are subject matter experts about the jurisdiction you are with, you can measure intangibles that just don't sit on balance sheet. You can assess the credibility of public policy and how its framework is going forward, be able to give a rating that ultimately is attractive to capital. So it is important that the association be able to give forward ratings that can be respected and rated highly, both for countries within, that we don't suffer from all good and perfect things come from abroad. Secondly, that we give the analytical depth that gives the continent its own authority. And also, thirdly, the success of the work that you do will be to the benefit as ultimately the geopolitics are shifting. Men are speaking of a fearful time in the world where they are asking, what happens to multilaterals? I am excited. I am excited for the following reasons. I'm excited because, as I think others are pursuing Greenland and etc., this has got nothing to do with just leaders who have gone out. It has everything to do with the control of trade routes. In a continent of 1.5 billion people, in a jurisdiction that is as large as was, in a mineral-rich universe, in a continent that will give to the world, as Steve Biko said, a more human face, to be able to reflect on our current credit rating, to be able to give policymakers in the continent the confidence that their capital can be costed accurately and also be able to deliver the returns it is. This is Africa's turn. This is a moment we can utilize to achieve that first opening invitation I gave to you, that if we get this right, we can build infrastructure that can move 300 million people from poverty to the middle class. We can also ensure that companies that operate within the continent have the confidence to know that as they invest further into the continent, they can realize their returns, but that their ratings are put forward accurately and properly. So I, in looking at this particular question, wanted to ensure that South Africa adopts a fairly similar protocol. I have already raised this particular conversation with the Minister of Finance here in South Africa to say we need a homegrown South African rating agency. A rating agency that is cognizant of our challenges, but clear about what we can deliver. A rating agency is that not going to be sympathetic because you're merely sharing its own space, but a rating agency that will be able to say accurately and fairly, without patronization, this is what the cost of capital can look like. And so if we get this right and we build the appropriate institutions, we as policymakers can ensure that this informs our infrastructural base, give confidence to people to deliver capital here, and for even equity firms to be able to know that when we issue our bonds and multiple institutions or instruments, we can ensure that those reflect truly how we feel about this continent, given that many of the economies that are growing are here in the continent. As we see some of the changes that are taking place, what better place it would be than to be in Africa. And so I wish you well, I wish you great success, and I really true hope that as we build greater institutions and collaborations across the continent, it is now, as The Economist reported in 1980, that this is a dark continent, and then further reviewed its own process to say this is a continent rising. May its next iteration be one that this is a continent that is prosperous. And so your work can never be more and more opposite. I thank you very much. Thank you.
Thank you so much, Dr. Maimane. We know that your time is valuable, and we sincerely appreciate the fact that you chose to spend it here with us as we witness the launch of something that the continent of Africa needs. Beyond today's session, we hope to receive a call or an email from you on how you are willing to collaborate with ACRA. Let us rethink Africa's credit future. Let us create the currency of trust. Let us collaborate for credibility. We have our desk at the back of the room if you have any questions or if you need anything answered regarding ACRA. Before we close, I'd like us to acknowledge the man whose work focuses on strengthening Africa's financial sovereignty and advancing credible, independent credit rating frameworks that better reflect African realities and economic contexts. Ladies and gentlemen, the CEO and founder of Sovereign Africa Ratings and the current president of ACRA, Dr. Sifiso Falala. He also happens to be an author of a book titled How Africa Defeats Itself, and this book is also available at the back for purchase. Thank you all so much for joining us as we turn the complaints of Africans into solutions for Africa. Everyone that has joined us in person and even virtually, we appreciate your presence, and we have now reached the conclusion of the launch of the African Credit Rating Association, ACRA, Africa's voice in credit worthiness. Thank you.